I was trying
Put
to
everybody
contact
on mute.
you.
I
I'll
think
call you after this.
please unmute yourself. So I'll put together.
What you're saying? Go to prepare.
So, Anurag, I can mute everybody and then
Ah.
who is speaking should unmute.
I have put the YouTube link on the chat. So one of you please circulate in all the WhatsApp.
Hari sir, can you do that, please? So very warm good evening to all of you. Anish, you are mute.
Someone is making me mute again and again. लगता है बहुत ज़्यादा बोल रहा हूँ. Anyways, you start please.
No, you always, whatever you speak is always so good for all of us. So that's obviously. All right. So good evening, warm good evening to all of you, ladies and gentlemen. Thank you very much for taking the time out this evening to join this wonderful event on the very prominent topic of today, which is startup and angel investing. I believe most of us wake up every day with a great idea. And that great idea has so much energy, so much passion, so much commitment built into that. If that triggers right, it changes people's life. So as we have grown up listening this, an idea can change your life. That's really true. So idea is bigger than anything. The idea is something that you conceptualize, you think about your own self, and basis that your strength and your capabilities, that idea is always thought of. So idea does not just come like that. It always comes with your strength, because your intellectual mind always thinks about your own capability, and that is the best judge to find out what is best for you and how you can reach out to your destiny. So think about idea, think about whatever your capabilities are, and always believe in that idea. So in the last decade, if I say that, there was always a challenging being people find an idea and there was nobody to support that idea. People used to find themselves struggling to incubate, number one, number two, to practice that idea and take it bigger. So if we take examples of Reliance, if we take example of Tata's and other bigger groups, there were the era where exactly somebody's idea was not that much popular and people used to take it on self. But today in today's world, startup is something which is commodity. It's a commodity, and people look into people's idea, uniqueness of it, and its viability to become sizable. And that's why the new concept of angel investing and venture capitalists have been born. And they have been really very supportive of every economy. If we talk about Silicon Valley, is all about angel investor and venture capitalists, where exactly lot many ideas have been conceptualized and taken to a great heights, the organization and businesses. We have seen in today's world. In UAE also, we have seen some of the greatest ideas which have been really they really worked well for the people who incubated it, and it really gave a great of returns that people can think of. So the world of angel investors and venture capitalists, it gave us a new lifeline to all the people who really believe in themselves and they believe in their ideas. So the lifeline is there. And today, the speaker of the day, we're going to enlighten about the topic that how the entire ecosystem of startup works and how the venture capitalists come into the picture, and what is the series A, series B, and series C, and pre-series and seed funding, what all the concepts are there, and how one should prepare for it. So I would like to thank our eminent speakers of the day today: CA Vikas Vadwan, Group CFO, PropTiger.com, Housing.com, and Makan.com. Ms. Shanti Mohan, co-founder and CEO of Let's Venture; CA Nimesh Kampani, President, Let's Venture Plus; Mr. Sanjay Jha, co-founder and Chief Product Officer, Let's Venture and My Startup Equity; and CA Devesh Rakesha, founder and CEO of Marwadi Catalyst, Ventures. So, ladies and gentlemen, I would like to say thanks to my colleague and managing committee, CA Sheetal Soni, to think about and conceptualize this entire idea, which is always supported by our chairman, CA Anish Mehta, who have been always ready to do events which really matters to our members and their needs. So I would like to place thanks to both of them for taking this entire things forward. And without a further ado, I would like to ask our chairman, CA Anish Mehta, for his chairman's address. The proceedings.
Thank you, Anurag, for your kind words. But you have taken in particular two names, but it's always the team effort. And secretary ke bina to patta bhi nahi hilta to. So thanks to you. Welcome everyone, all the members, all the eminent speakers, all the guests. Before we go on today's event, we are also trying one event on the investment outlook around the world. Most probably after a week we will have. We're just awaiting confirmation from the speakers. After that, on the 2nd of February, we are trying to have an event on the Indian budget, which is going to be presented on 1st of February. So we are again trying for the good speakers, and we'll let you know as and when things are decided. Talking about the today's program, it was always in the mind to have a kind of event where we can get some knowledge on the basics of the startup, because right. I think some.
Anish, I am muting all. You please.
Yeah, so it was always in the mind to do the startup, because I think you all will agree we cannot live without the startups. So why not make startup as also a point of view from the investment point of view? And if someone would have seen my seen the chapters WhatsApp, chapters LinkedIn, there is a very beautiful quote from the Jeff Bezos, who's the Amazon founder, that we are our choices, build yourself a great story. So we want chartered accountants to think from those lines, that maybe one idea can build up their story, and one day they'll be on the chapter platform to present their case to the members. So today we have an event on startups and angel investing, and as Anurag said, eminent speakers from Let's Venture is there, and who will going to take us about the understanding of angel investing, decoding equity management, and there is a one CFO of the startup who will be interviewed by Saina of Let's Venture, and we'll try to unlock that what is the reasons behind the success story of that startup. So the overall theme is decoding private markets, its landscape and opportunities. And at the end, we also have a session, and we have an eminent speaker from a tier 2 city who is also putting his brains that how in tier 2 and 3 cities startups can be developed. So we have Devesh, who's going to talk to us his experience. But most importantly, that out of 5 speakers today, we have 3 chartered accountants. So we can easily see how chartered accountants are making the impact. So we have Nimesh, we have Vikas, and we have Devesh, who are chartered accountants. So all the best to all the eminent speakers and all the members. The very recent example which we use, that we are talking on Zoom, which was one day a startup. And then secondly, earlier we used to go to the grocery shop and used to order everything and was asking the grocery shop to deliver at home. And these are now done by the Uber, Deliveroo, and all these people. So these are all startup, just an idea that how we can reach to the customer rather than customer reach to us. So with this note, I once again thank you everyone, and let's have a great session. I also want to learn from the eminent speakers. Thank you.
Thank you so much, Chairman, for giving us some insight on the upcoming events and things. So thank you once again. Can we have a round of applause, everybody, for the Chairman for in the New Year first event that we are trying to do. Without a further ado, I would like to ask our Vice Chairman, C.A. Sundar Nurani, to introduce our first speaker. And before he comes to introduce our first speaker, I just want to say that startup please do not think that, every idea is small. Every idea is bigger. It just like, I met quite a few people also in the recent time, and everybody, even they're very established people, or they are very dynamic in their own businesses, whether it's a professional practice or a business. Everybody thought that when they started, they just believe in one thing, that I need to do this. That's it. And it becomes success. So please believe in whatever you do. Over to you, C.A. Sundar Nurani, Vice Chairman, ICI Dubai chapters.
Thank you, Secretary Saab. Again, Happy New Year to all of you and those who are celebrating Pongal and other Indian festivals. Enjoy the festive season. And there is a saying in Tamil, which I just want to put for everybody's perspective. Thai Porandal Vadi Porakam means when this 14th January happens, new things will happen, which is good for all of us. So we are starting this year's event with the startup. I believe that the speakers will put the spark on each of us. And when we close 2021 December, all of us will have a different startup story to share. Some of the great startups in UAE, you would have heard about Souq.com, which is getting acquired by Amazon, and the low-cost airline, the Air Arabia. That is also a couple of years before we just idea was conceived by someone and it got implemented. So we have very big success stories in UAE as well. So thank you for introducing CA Nimish, our own man. Nimesh is an alumnus of Harvard Business School and a chartered accountant with more than 18 years of experience in banking and financial services. Currently, he is president of Let's Venture Plus, a growth platform designed specifically for designing investors to access exclusive investments across growth stage private companies, unicorns, and global funds. There is a big, the story behind Nimesh putting all these things. I would like to hear from him rather than reading his entire profile. So without further ado, I would like to invite CA Nimesh Kampani, and please join me in welcoming CA Nimesh Kampani. Over to you, Nimesh Kampani, sir.
Thank you, Sundar. And it's a privilege to be speaking to fellow chartered accountants, and I think taking out time on Saturday. Thank you, Anish. Thank you, Anurag. Thank you, Sheetal, especially for making this happen. So I think since we have half an hour, and I'm sure everybody is on the edge of the seat to listen to us. So let me just quickly start with what I need to cover. Let me share my screen. I've got a small deck prepared. We can just go through that. Yeah, is my screen visible?
Yes.
Yes.
So what I'm going to quickly touch upon today is some basics of angel investing. And I think one of the other key topic which some of you touched upon was on what to look in a startup, and how should finder look at raising fund. I think that can be covered at a separate point in time. So today we'll focus from the investor side and how do you start your angel investing journey, and how do you think about investing in startups, right? Yeah, so I think just a quick one is that so LV is the largest marketplace in India, right? So we have a 30% market share in all early stage funding that takes place in the country. We do around 10 to 15 startups fundraise a month. So I think it's just a quick brief. We did double the number of startups in 2020, just to highlight that was the year when COVID was there. And in spite of COVID, you were able to double it from 55 previous year. And of course, other things that worked for us that year was enterprise SaaS, EdTech, consumer goods, and health tech. So I think overall, I think it has been a great year for angel investing, in spite of it being one of the crisis year through the world, right? I don't want to touch upon the other points, just quickly wanted to take you through that. So I just wanted to come around the history on how did startup ecosystem start in India and how did startup investment start in India, right? If we just go back in time, right, 2008 was a year when global financial crisis hit the world, right? That's when I think IT sector was the most impacted, and that's when a lot of IT employees who were jittery about their jobs or who were let go, they started thinking of becoming entrepreneurs. Right? And that's when the entire startup push started in India, which really got a big fillip. So in 2008, when it started, if I were to look at 2010, you had around VCs had pumped in around $250 million in startups in India, right? And today that number is 25x at 15 billion. So in India, we have come a long way in terms of investments in startup. It has completely, if you look at it, the early stage has been completely democratized and organized. I think we are trying to do the same with growth stage, which Let's Venture Plus that we have started. But I think there's a lot of interest. There is a lot of maturing of the startup ecosystem in India. And if I were just to look at today, India is the third largest startup ecosystem in the world, right? I think apart from the other numbers, which you would have obviously read somewhere or the other, I think I would just want to stress upon the number of unicorns, and I'll tell you why, right? Today we have around 38 unicorns, right? The number keeps on increasing every day. The last one was added yesterday, I think, when I read about, I forgot the name of the company, but yeah, there was one more added yesterday. And if I were to look at the entire ecosystem, US and China are number 1 and 2, right? So there are totally 600 plus startups in the world. US and China have around 250 each, right? And we are just at a number of 38 and we are number 3. So I think there is a whole host of companies waiting to be unicorns in India, right? And it's a long list. It's just that, you know, we need to get our act together. I think we have got brilliant products. We've got brilliant entrepreneurs doing great work in different areas. And I think as we go ahead in time, and that's why we say that the next decade, right, the decade from this decade that we have just begun, will see the maximum number of startups unicorn coming out of India. And obviously that will, just from the 5% share in that entire universe, I think we should definitely move up. And I think the largest wealth creator that you will see in this decade will be coming from the startup ecosystem. Right? So just going into what very briefly at a very top level, I think, you know, everybody will be very familiar with public market investments. All our CAs, I'm sure everybody is an investor as well. I think primary driver that you always have is wealth creation, right? Private markets goes a little beyond. It's not only wealth creation, but I think promoting innovation, entrepreneurship. I think a lot of passion goes there. I'll come to that as we go ahead. Business models are really proven, right? You know your valuation multiples, you know, P by E and P by B, and all of those things are in place. Here, I think when you look at private markets, I think some of those things just would work, right? You cannot look at cash flows, you cannot look at P by E. I think it's all a huge high growth story that you're betting on, right? I think, of course, as I said, it's at launch and ideation stage, whereas most of the listed companies go for IPO when they almost hit a growth stage to a mature stage, right? And obviously they have free cash flows. So not only just financial motive that you would invest in startups, but I think it is also a lot to do with, you know, mentorship, advisory, opening doors, you know, guiding the startup, because the startup entrepreneurs are very passionate about the idea they have. But sometimes, you know, we need to take them through on their journey with our experience, you know, with our relationships and all, and help them out. So I think it's just going beyond just writing a small check, right? I think so, as I said, right, making money obviously is an objective that everybody has in mind before you start your any kind of investing journey, right? I think this is startup investing is diversifying your portfolio. But as I just mentioned earlier, yeah, it's basically to support entrepreneurship, leverage your relationships, and of course, you know, you will also be in touch with the latest happenings apart from what we do regulatory on our CA knowledge, right? It just goes a little beyond, and you actually know on what are the innovations happening and what are changes happening in the world. So you want to start off, right? I think it's not, I wouldn't say it's very simple to start off, that you just go about start investing and spraying and praying your money. I think what we say is that actually, once it's a very liquid portfolio, right? When you build a startup portfolio, one of the prime things is that it should be a portfolio, right? It should be money that you are okay to lose, because in a startup, you know, your money can be zero or it can be a multiple X, right? So I think it should be some amount of allocation from a portfolio, which is play money. Build a portfolio of companies. It cannot be one or two startups. A friend is starting a startup, then you put money. I think what you need to do is build a portfolio, because what typically Kaufman study has also done, and what we typically see is that in a portfolio of 10 companies, around 5 will return your money, right? Around 3, you will lose everything, right? 3 to 4. And around 1 or 2 will give you multiple X. And that is what will take care of your portfolio return. So I think you need to spread out your bets, So start with play money. Of course, that is something that you are okay to lose as well. It should not be a momentum play. So what we mean by here, it should not be something that you are seeing all the time in public news. You read about it in the papers. So now let's go and see if I can get something, because then the entire world knows about it. Right? And if the entire world knows about it, it's no more angel investing. You're going beyond angel investing or to further stages. Right? And I think here again, so it's a game of building right entrepreneurs, right ideas. Right? Idea is very important. Right? Anybody and everybody can get it, but the key lies in execution. So you are never going to be able to say for sure when you are angel investing that this is a winner, right? Because with the idea combined with execution in the team is what will give you the results over a period of time. So I think that's what you need to be very careful on. So I think I would just like to add here that there are a lot of angel investing platforms. There are a lot of advisors. There are a lot of people who do this, right? But I think not to get swayed away by promises of returns. I think a lot of people do that. So we never, at Let's Venture, at least I can say that, we never advise that you should put money in this or not put money in this. It's an investor's call. And we'll never coerce you, कि इसमें डालो, 25% return निकलेगा. That is something that is a clear red flag. And I think everybody should be very wary of when you're taking that decision, right? So how do you go about this story, right? I think the first thing you need to sit down and write what is going to be your investment thesis, right? What is going to be your thesis in terms of, what do you want to invest in? What is the future according to you think is going to be, right? It can be stories of behavioral change, like as Anish was mentioning that, right? Earlier we used to order food and now there is Deliveroo and Uber and everything that gives you that food. Education is now available online. EdTech is the flavor of the season. I think everybody has been doing that. So I think there is a lot of behavioral change that is happening. Groceries are being ordered online. So is there a thesis you want to follow, right? Or you can have something like, what are the future? Like AI is something that is out in the future. It may be 1 or 2 years away. I think health tech, if I were to look at health tech in India, what we have seen till now is pharmacy distribution. But you have not seen advanced medicines, advanced research. I think biotech, all of this is yet to come into India in the startup space. Right? It's very early days. So I think you need to define your thesis as to what you want to look at. Where are the non-linear changes going to happen, right? What will be very disruptive, right? And primarily always go for blue ocean strategies. Red ocean is a very crowded space. Blue ocean or a white space is what one should always look at, right? That is where the differentiator lies. If I were to look at investment strategy, right? I'll come to investment strategy in detail in the following slide, basically whether it should be diversified or thesis based, and ultimately what are the expectations on exit. I will come to each of that. So as I mentioned, your investment thesis is future oriented, right? India's story continues to remain strong. The consumption drivers are very favorable for India. I think, as I already mentioned earlier, right? Next decade, so this current decade that you're going to see is going to be a path-breaking one in terms of wealth creation through startups. You see a lot of execution ideas in SaaS, in enterprise tech, in health tech, EdTech. Anyways, you're seeing a lot of them happening. So I think India is at that cusp where obviously we'll be benefited with a huge population. Bharat story is going to work very well for us, and a lot of startups are focusing on that. Right? So that is what can be one, and behavioral change. I went into detail and I discussed that as well. Coming to investment strategy, once your thesis is decided on what you want to ultimately achieve, typically what happens is either you have a very broad beam strategy of diversification, or you have a very narrow beam thesis based investment strategy, right? Typically what ends up happening is that you will normally be aligned and you will like startups which are in your space of knowledge, in your space of expertise, and say a CA typically will largely go for fintechs because your understanding of the financial markets is better. Doctors will like medtechs, so on and so forth. But so typically, I think the best way to go about doing is that I think it's all about your investing passion, right? How much time also you're going to be able to give, as I said earlier, right? I think obviously everybody will have their own area of expertise, own area of domain knowledge. But I think how can you be a big believer in the thesis that you want to build out on? So I think ideally what has worked and what has worked for me as well when I started angel investing is I go with a diversified theme where obviously there is certain allocation to my core sector, core domain knowledge sector, and balances across the board. Here again, I think one very important thing that I would want to point out, and that is something I very closely relate to, is that you should look at each opportunity for investment in a startup as a student. Right? I think when you're looking at any startup, I think go deep into it, trying to understand the business, right? Idea, problem, business, people. A lot of that helps a long way to go into your thesis development and go into the strategy. Once you do that, you know what the startup is all about and where it is going to go. Right? So I think it's very, very, very important to be very humble in your investing approach when you're investing with startups. And at the same time, I think being open to learning. I think that is one very key important thing that I learned in my journey, right, as a startup investor. And of course, this is one very important thing that, exit expectations also determines your entry strategy, right? So competitive market, obviously it becomes very difficult when there are too much competition. That's why we said we should look at white space. Differentiated companies as well, it will make a lot of difference. So I think it's all about what kind of team the company has, what kind of product market fit, product customer fit you've got in place, and all about execution. I think the depth in the idea, the technology being used, and execution is always the key. Right. So I think I'll quickly take you through, I'm just looking at the time, on evaluation of a deal when it comes to you, when you are looking again for your investing strategy, right? So once you've determined your strategy, obviously it will fall into one of these buckets, right? So be it diversified or thematic or whatever makes sense. I think it's important to validate against your thesis on the deal or on the opportunity that's come to you. I think talking to experts also helps, right? And of course, the kind of detailing you will go into that is what kind of team is there, what kind of investors are already committed to it, right? The opportunity set, problem that is being addressed, and the solutions being offered to address the problems, the kind of scalability that is envisioned, and the vision of the founders. I think that is one very important thing. I've seen founders come and pitch beautiful ideas, brilliant ideas, but somewhere I see that, the business acumen is missing and it falters in execution. Right? So I think you need to go so deep into it to understand what is the vision and what is the execution capability of the founder and the team that he's planning to do. But ultimately, the growth of the company will happen when execution is top class. Right? You have to execute for scale. Right? If you remain within a small labyrinth, it's not going to become a pretty big thing, and that's where it doesn't make sense for any investor. Right? So obviously you will look at the team. As I said, you will look at the revenue. Whether it's a revenue generating one, or if not, when is the visibility of revenue, right? And obviously a journey to EBITDA is always looked at positively, and that's why today, if you see worldwide, SaaS companies are very, very popular. Right? Because they generate revenue, and the stream of revenue they keep on generating is on an annuity basis. Right? So I think just getting the product right or just getting the market right, you need to see on the execution side as well. Right? I think so. Some of the questions, obviously, that you ask is on scalability. Right? I think is on engagement of users. So when you're doing an angel investing, it can come to you at a very early stage when it's only a product that is designed, or you have some test users that are already signed in. But I think what you need to check is not only that the 10,000, 20,000 users that have signed in, what is the engagement of these guys? How many are repeat customers? Right? How many of them are paid customers? Because the validation of the business comes when somebody is ready to pay for the service that you are offering. Right? So I think that is some of the signal that you will see when you're looking at startups that come your way. Right? And I think this is something pretty important in terms of the product market fit. Right? I think this is one of the primary reasons for the startups to come, because the founder would think the idea is great. Right? I think they found a brilliant idea, but I think somewhere it doesn't fit in the marketplace. Right? The users don't really accept it, and if the user is not going to accept it, the company is bound to fail. And we see that in so many companies that come to us for their fundraise plans, is that you will see an early death. So for example, right, I won't name the company, but say in the US, you have online wealth managers for Betterment and the other one, I forgot the name. So they've done very well. Right? They are basically a platform for online investment into mutual funds and stuff. Right? We had a similar company which was started in India. It was a very good product. The product was very good. The founders were very good. But somewhere the market fit doesn't work, because in India, mutual fund investment is a push product. Right? Investor is not going to come to buy a mutual fund. Ideally and typically, you see it is a push product. There are always distributors who go and sell. Of course, today the scenario has changed. It has improved, but ideally it starts as a push product. So I think that's where it just faltered and it had to shut down. Right? Same was the reason, pivoting it too early. The idea was copied immediately when the US had launched, and US is always around a decade ahead of India in terms of the evaluation of products, in terms of evaluation of the marketplace. So that is what called for a failure of that company. Again, another beauty company. Similar things, the product was too early and they had to close down. In fact, COVID is another situation where the product market fit came to play in, say, one logistics company. They were doing brilliantly pre-COVID, right? Their revenues were around 60-70 crores a year pre-COVID. Post-COVID, it became zero. Right? They could not. So I think those are the kind of things that will happen, that you will see. But I think at least if you're able to do the preliminary check when you're looking at investing, I think that can help you out. And of course, entry price is right. So I think what we encourage angels is to follow syndicates, to follow lead investors. I can see some of you on the forum today are lead investors with Let's Venture as well. So I think they are the ones who have done their entire hard work. So when you're just starting off your journey, piggyback on some of these great guys who have experienced it, who have done this multiple times, who know their way through. And once you learn the tricks of the game, I think then you can move in as a full-time angel and you yourself can become a lead. I think this is another thing that we discussed, right? I think this is one of the biggest factors for a winning startup and a failing startup, right? I think it's the team. The founding team is very important. I don't want each of the founders to be copycats of each other, right? They should not be thinking the same. They should not be from the same background, because ultimately what you want is complementary genius, right? One can be a very strong operations guy. The other has to be a very strong tech guy. The third has to be a very strong business guy. I think you need the right mix, the right secret sauce for the success. And of course, all of this has to be backed by deep passion, purpose, the integrity. I think all of those come out when you start talking to them a lot. So as we said, what do you look at, right? In when you are doing this evaluation, I think the category winners is the product that is envisaged, nobody else doing it. Is there a moat in the product? And how will it work? Regulatory approvals in place, relationships in place. How can we also contribute with network effect? Of course, domain expertise of the angel investors is right there. And of course, we can also give leads into who can come in, the right set of people for the contribution to success. And basically, I think the most important question is, what will it take to win? Right? What will it take? I think every investment that I would make, my question would be, what will it take to make it 100x? Right? And that's what would validate the thesis. Right? If I have to be 100x, what is the amount of capital required? What is it required from the markets to take it there? I think some of those basic questions, if they get answered, I think it makes a lot of sense for you to go ahead. So I think COVID-19, I think, taught us a lot of things. I mentioned earlier that a very successful startup who had raised Series B funding, was doing 70 crores top line, had to close down. Right? So I think a lot of startups have gone back on the drawing board, managing the liquidity, reducing cash expenditure, focusing on technology for leveraging what they are doing, and of course working with new channels. And also the good thing is many of them benefited. Some of them in the travel and tourism segment, some of them in the service segment suffered. But large part of the startups, I think, did pretty well with the changing consumer behavior that we had seen. Right? So I think obviously this is something that we can leave aside for a future discussion in terms of, what are the kind of structures used. A lot of them are convertibles. I think it's always convertible that you start with, and what kind of deal sizes and all make sense. But I think this we can leave for a next time. Quickly, these are some of the basic rights in terms of what you look at when there's a term sheet you are signing. Valuation, clawback, the founder vesting is pretty important because you want all of them to have skin in the game. Drag along and tag along is important for you because you don't want to be left holding the baby. Liquidation preference. So, of course, normally the founders will have equity shares which are lowest in the liquidity preference, and each round of pref share is at a higher liquidity preference as you go ahead. And of course, your preemptive rights and information rights in place. I think obviously post-investment, there's something very important. And something that I would highlight is that I think it is the vision of the founders that you are subscribed to, right? It is the strategy that the founder has that you are subscribed to. So I think many a times you have seen that a person who's writing a large check wants to drive the company. I think that doesn't work. I think we should ideally let them run the company. Of course, we can give our inputs. Of course, we can give whatever you want to advise. But I think let them run the company the way they want, right? I think being a coach is maybe the right attitude here, instead of trying to drive the company as the founder itself. And of course, you have your quarterly updates in terms of your information rights. And I think prioritizing is one other important thing. And I think it's very important for CAs because for us, the red flags go up if he has not filed a return, right? Or the red flag goes up if he has not done PF. I think some of those things get ironed out when they go for Series A, Series B funding from venture funds, right? Because till that time, I think let them focus on business. I think some of those compliances, which are not intentional, I would say, non-compliances there can be looked away and moved on in life, because I think their focus is to run the business, to grow the business. So I think it's okay if there are a few lapses here and there. Obviously, consistent lapses are not good enough. But I think somewhere, we need to have them prioritize on the business side of things rather than on compliance side of things. And with the kind of compliances we have in our country, I think you know how it goes. So as I said, some of the things I covered, be a bottleneck, right? So not to do. These are things you should not do. Don't be a bottleneck for them. I think chemistry is something, if you see that upfront, there are issues, I think it has to be sorted out. Otherwise, the startup is doomed to fail, right? Because once you have human issues, interaction issues, I think it's the end of it. You can always feel free to connect with them. Be advisory, as I said, right? Don't get into too much into insights, relevant information, and as I said, don't prescribe answers. Right? I think they should drive it on their own. We can always advise from the outside and tell them what to do and what not to do. I think so. So this is just the statistics of what you see as a benchmark, or the kind of companies or the success. YC is the largest accelerator in the world, Y Combinator, where they funded 2,000 plus companies, right? And they're the ones who've been the most successful. And even if you see the success rate, right, just 1% of them have crossed $1 billion, and then there is another 5% which has crossed $100 million, right? So that's what your winners are. Select few, right? That's why I think you should look at multiple investment opportunities. And one of the other things that we have seen is that the right deal flow is the biggest challenge in this segment, right? And I think that's where associating with angel investing networks like ourselves, I think go with the largest and the biggest. That's where it makes a lot of difference in terms of how you would look at deals, what kind of deals you would get, because everybody gets deals from their network, but are they good enough is what you have to think about. You want to look at many more deals. Like, as I said, we close around 10 to 15 deals a month. So I think it has to be a wide gamut of opportunities to look at, rather than, just one or two that come your way every month, because maybe it's your client, son who's starting a company, or friends or a friend is starting a company. I think that I would request you to look at more options out there in the market. Right? I think I can pass on this, but this is what we do in our journey in terms of fundraising, where deal sourcing is personalized. We look at 3,000 plus companies and only filter out less than 300 a year. Obviously, we do a detailed DD. We get into co-investor discovery as well. We do that fundraising, and of course, you can track the portfolio on a platform. Just quickly about the things that we have done. We have more than 18,000 startups, 7,500 plus angel investors, 200 plus family offices. Portfolio value is around 1.5 billion. We have raised money for 315 companies. This year, as I said, 105. Some of the marquee angel investors on a platform, right, who also run their own syndicates. Anupam, Ramakant, Mohit, Vivek. Our board members are Sharat Sharma, the founder of iSpirit, Anupam Mittal, founder of People's Group, Shadi.com founder, Manav again, founder of Eka Software, Mr. Ratan Tata, Mr. Mohandas Pai. They don't need introduction, they're advisors, obviously the other influencers who have worked with us. So I think that's where we are in terms of what we do. And I think our objective is to, again, as I said in the very beginning, right, we want to enable from the investor's perspective, be their private markets partner, cover that entire spectrum of investment in private markets, right from early stage, all the way to, right from early seed stage to all the way to pre-IPO, right? Look at equity. We have just launched a fund in debt side. So look at debt. I think trying to be the entire private markets for the investors, and at the same time for the founders as well. So I think that's where I think I've almost done with my time. So if there are any questions, you can go ahead and ask me, or you can follow up with me on my email or my Twitter or wherever you want.
No, there are a few questions for you. We will not let you go like that. But first, I'll ask you a very basic question.
Yeah.
Why it is called startup? In the sense, can a mature company can also do startup? And secondly, why it's called angel investor? Why angel word?
Yeah, so I think that's a very good question, and let me also think. So I think startup came around, that word, I don't know how it got originated, but it's all the new age technology company. So today, say for example, I agree with you, you cannot call Policybazaar a startup. Like startups are the companies. So typically when you're angel investing, they're startup. They just begin. The journey is just, you're just raising money for them. And that's why they are the startups. And angels are the one who basically are the ones who are supporting the idea, right? I think without that support of angel investors, that company would never have seen light of day. So it's a very, very important, factor there. Sorry, I just stopped sharing my screen. So I think the angels are the ones who basically are the guys who are enabling that startup to go off the ground. Because that's the point of funding.
Great. So Anurag Sheetal, you can take forward.
Yeah. So thank you, Nimesh. It has been a wonderful session, a very short, crisp, while at the same time very meaningful presentation that we had so far from you. We have few questions from our members. Ashit has been the one who has posted his first question. In fact, we have got 15 minutes, so probably we'll try to spend between 4 or 5 questions. So Ashit, I am unmuting you. Please go ahead with your question.
Mr. Ashit, but not 4 questions, huh?
Try to be crisp.
Nimesh, can you hear me?
Yes, I can hear you loud and clear.
Yeah, thank you so much for the excellent presentation. To just 2 questions I will restrict to. So one is, in case of agri-tech ventures, what is the basis of valuation you recommend? And second is, how do we do the valuation for social impact? Because a lot of ventures nowadays create a lot of social impact, and many semi-government bodies also are available for funding for that. So how do I do a valuation of a venture which creates huge social impact?
No, so I think here what you need to see, Ashit, is that I think there's no valuation benchmark in the startup world. Right? Typically, the benchmarks are on the rounds of funding and the size of funding when you start off, because there's nothing, right? It all depends on whether you have a product ready or not, whether the team is ready or not, whether do you have already got customers in or not, are the customers paying customers or not. So obviously it depends on all of that. But say typically when you're doing angel investing, which is at a very early stage, where you would have just done the beta of the product and you're just raising money, I think the first round typically is around less than $500,000. So less than 3.5 crores types. And typically you dilute around 10 to 12% for that. It depends from case to case, which stage you are in. So you cannot put a thumb rule to that, but I think at a very broad level, that is something that normally investors also would be comfortable with. So ultimately it is the lead investor who will determine the value of the company, right? We cannot use any of our traditional methods because there is no cash flow, there is no earnings, right? So I think it's basically the product maturity. I think what a person would want to look at and any investor would want to look at is the maturity of the product market fit, the product customer fit, right? The kind of UI UX you have, what is the stage of development, what is the stage of customer contracts. So I think it will go into all of that if it's a B2B and a B2C on number of consumers that you have and paying customers, right?
Thank you. Thank you so much.
So the next question is from Bhavna. Bhavna, I am unmuting you. Please go ahead with your question.
Yeah, am I audible?
Yes, very much.
Yeah,
Please go
yeah.
ahead.
Hello, Nimesh. That was a very interesting and insightful presentation. Basically, I'm an advisor to a startup. And as the earlier question was regarding how do you do the valuation in terms of social impact, but I'll skip that because you've already answered it. Basically, I want to know whether you are sector agnostic, number one, because this is an ed sector that I'm talking about. Secondly, what is the time frame between when we approach you and when it is actually the due diligence and all that? Because I have a big challenge about a mandate, because as you see, I approach you, then I talk about it and I talk to others. Many times the investors approach me and they said, no, we are interested. So then how do I handle this mandate part? So that is the thing that I wanted to ask you. And when is a tilting point? I have the seed capital and I also want to go for angel. So I want to go as soon as possible because I want to get that traction. So what is the tilting point and when should I approach you?
So, thanks for that. So we are completely sector agnostic, right?
Yeah.
It is new age technology is what you look at, right? Obviously, we have certain filters. So when any company wants to apply to us, most of the companies apply very directly to us, and of course, we work with people like yourself as well. Is that they will bring in there is some prescribed things that we look at. Right? I think our sourcing team will have a call with them. They'll go into detail with them. And of course, we'll also see in our pipeline if there are competing companies that we already have, what are the kind of investors you have, what is the efficiency and what is the quickness with which we can close the transaction. Right? So I think typically we get applications, as I said, around 300 to 400 a month, and we do around 10 to 50. Right? So I think that is the filter that we have. We ourselves do some amount of knowledge basis since we have that huge pipeline of companies, right? Because I just don't get each and every company that comes on our platform to raise money for it. No, I think that is something we avoid. We do a lot of tertiary checks as well in the marketplace with experts in as well. So the way it works is that once the initial screening is done, it's approved for fundraise. Terms are already there because you would have a lead investor and somebody else already there. I think my early stage team would put it in the pipeline to launch on the platform. Once you get the commitments, because we already have 8,000 plus HNIs and family offices and all, once that is done, the full commitment has been received, then we get into a detailed DD. And the DD we do is unlike any other DD in this country. Like no other, people will promise you money very fast, but I think that's where the compromise happens. So I think DD is something which is very important, which is very well appreciated by investors. Right? So we do a financial and a legal, we don't do business DD. But I think we go through that process. And then we get into SHA, term sheet SHA, and closing the investment.
Thank you very much.
Thank you very much. The next question is from our senior chartered accountant Balaji. He is asking. I'm not sure. Balaji, are you there? You can ask him directly, or I'll read out it for you. So let me read out. So his question is, since risk and rewards are high for angels, are there any measures to mitigate the risk? Do you get involved in the management of the companies where with whom you help investing and who you help in their
so I think
process?
So Balaji, I think it's a good question, and I think what you need to decide is what you want to do as an investor. Do you want to play a mentor's role? Then you can select 5-6 startups, be mentor to them and go deeper with them. Of course, them agree, right? Or you want to be a pure play angel investor who will invest in say 30-40 companies, selecting basis on your investment thesis and investment strategy and invest on that. So it all depends on ultimately what you want to do, right? Because you cannot be a mentor to 30 companies. You can't get involved at a micro level in 30 companies. You can do that with 4 or 5 companies with what you are already parallelly doing, right? So that is very important decision point that you need to decide for yourself what you want to ultimately
Wonderful.
Okay,
So,
Nimesh, one question that I have. Some of the members are asking the question: at what stage they shall approach basically a angel investor or a seed partner itself? What is the stage? Because somebody is a conceptualized idea. Is that time they shall come to you, or they start things and they prove their entire concept and then they reach out to people? So what is the benefit, like, starting too early at the conceptualization stage or after starting the entire concept? What is in your opinion?
It's up to, so typically you go to the rounds of funding. I think you touched upon in the beginning. So let me just quickly take 5 minutes since we're time. The round of funding that a startup goes, right? Say couple of friends come together, they just cleared from IIT, and that is typically what you see. Two or three of them come together. The first thing they'll do is they'll do bootstrapping. That is put their own money, right? So maybe 10 lakhs, 20 lakhs, their own money, and they'll start the company and build the product, right? The next stage is when they have something ready. Maybe the idea is ready, maybe some amount of product is ready. They want to build a team, they want to go out and get customers. You will take some money from either friends and family, or you will go and join an accelerator program, because accelerator program not only gives you some amount of capital, but at the same time gives you some amount of mentoring in different areas of what a startup should look at, how the startup should look at growing, all of those things. So you would want to join an accelerator program, or you will do a friends and family round, right? The next one is where the angels come in, because now you have got, in a way, a product in your hand, you have got some customers in your hand. I think you want to now go and raise angel money, right? I think that's when you will start getting some validation in terms of, you want to get investor validation as well. So I think I would put it as a third round. You finish your bootstrapping, you finish your friends and family accelerator rounds, and then go for the angel round. Typically, that's how it happens. And then after that, the journey is your Series A, Series B, and it goes on till all the letters are over.
wonderful.
That's so
Thank-
nice.
Thank you. The next question is from Vivek. Vivek, please go ahead and ask your question. You need to unmute yourself as well. Yeah, please.
Yes, I did. Thanks, Sheetal. Thanks, Nimesh. I think it's been a very enlightening session so far, and I think you're probably doing a great job of angel investing. I just need to step back a little bit. The question here is that looking at there are a lot of business ideas. We as advisors, I'm a chartered accountant in practice, working with Grow for a couple of years now. So we do leave a lot of ideas. People come in and then they look at investors and so on. So, but the first question they ask is, what is what I'm going to give away at the time of an angel investor coming in? So what are the par for course, you can say, terms agreeable to, say, I come to you with a great idea and you said, okay, so how do I satisfy you? What are your minimum requirements? Are you really in an angel is something where you bail me out in a tight situation? And what is your time frame you're looking at in terms of how your exit strategy would be 3 to 5 years? Or you're looking at, so as you reach, say, a certain scale and A and B and C series start in, what is your generally, how do you feel? And what are the standard terms and conditions, term sheet, how extensive it is? Is it, sometimes these kind of discussions can scare away also the investors as well, or the founders?
Yeah. Well, I think Vivek, you brought out a very important point, I think, which I also forgot touching upon, right? I think a lot of good founders who have very good ideas come to people like us, CAs, for advice, angel investors who write checks of 50 lakhs, 1 crore directly themselves. What I've seen is that if the founder gives away too much at that stage, right, for a small amount of money, that company will fail, because they will not be able to raise big money in the future. Because by the time your dilution, you should at least have majority stake. Right? And if you are giving away at a very early stage 30% of your company, right, it will not grow, because you won't get money, right? So I think that's in the beginning also, when you are doing early stages, the dilution should be minimal, right? Around 10 to 15%. I think don't take more money than that is required, right? Because you can have a follow-on round after 1 year once you have grown. But at the same time, I think typically, obviously, the angel investor has to be a patient capital investor. Money is in for around 5 to 7 years. Because if you see India is not as evolved as the US. In US, an up round or the next round happens within 6 to 12 months. In India, the next round happens between 18 to 24 months. Right? It's a typical generalized scenario. So I think you need to be much more patient for your exit, because your exits will only come after Series B, Series C rounds have happened. Right? So I think much more patient. I think create a win-win situation when you're negotiating or when you're talking to the founders, because ultimately this is what they are building, right? And you're putting in money with a smaller stake. If you take away a large part of the stake, I think the startup is built to doom. I had a similar experience. Let me share that with you, right? There was a brilliant company with all patents and everything in their name, right? The founder was a master in their industry, in the sense that they had done a lot of work in that industry. It was a beverage company, but one of our CA brothers, right, who was advising and mentoring them, gave them 50 lakhs and took 40% stake. Okay, so, and that's where it killed it, because a beverage business, consumption business needs a lot of capital. Right? And after 2 months, the founder is left with 10% stake. He has no skin in the game. He's not interested to run the company. So why would any investor come in, right? So I think we as advisors will be very wary of that fact. And I think we should do what is right for the company to grow, right? And I think we should step back on our expectation on what we want. I hope I answered your question.
Thank you, Nimesh. I think we have got 2 more minutes, and then we can take probably 2 questions very quickly. And the next question is from Mr. Mahalingam. So please go ahead, sir.
Thank you. Thank you, Nimesh. Great session. I have a quick question for you. What is your thoughts on formulating the runway that a startup would require when they fundraise? If they raise too much for a long runway, then they're giving away too much equity, as you just mentioned a few seconds ago. If they raise too little, they're going to be back again with a cap in hand, wanting to raise further capital, and that would take them away from running their business per se. So what kind of a formulation do you run?
So I think if I were to look at when you are looking at an angel round, right, that's a pretty early round when you want to get your team right. I think you're raising the money for your team, getting the technology in shape, right, and getting your basics right. Obviously, with some amount of marketing spend you might have, right? So I think at that stage, you just take enough minimum requirement for a 12-month period. Because maybe say around 9 months down the line, when your product is solid, we have proven the product, you have got customers coming in, you will start your next round road shows and, talking to people to raise the next round at much higher valuation than diluting yourself completely. So I think I would look at a 12 to 15 month as a period for which I would raise money today.
And a bit later down the road, once your product is launched, for instance?
So once you are done, I think you are now in pre-series A and series A round. Right? So you do pre-series A between the 12 to 18 month, and then you do series A around the 22 month. So the pre-series A, you will do typically a convertible at a discount to the next round. You want some sort of funding for your marketing spend and growing the business before you go for a proper series.
Typically, what discount do you keep between pre-series A and series A?
So that pre-series A convertible paper, which comes with a caveat of 12 months. Typically, what we have seen is around 20% with 1 month. So 20 to 30 ranges in that range.
Very well. Great. Thanks a lot. Appreciate it.
Thank you,
Thank
Mr.
you,
Mahalingam.
Mr. Mahalingam.
Mr. Anish, if you don't mind, I'll ask a lighter question. In valuation, you touched about Nimesh valuation, and we have been hearing that the traditional valuation doesn't work, and we understand that aspect. And we have been hearing some new valuation techniques that's being used, and some English names like Barkas methods, scorecard methods, risk factor simulation methods, and all that. When are we going to hear some Indian chartered accountant developed method, say a company method of valuation?
Let's see. I think it is an evolving thing, right? It's an art, it's not a science. Clearly, valuation is an art, and it's much more artistic when you are valuing a startup than it is when you're valuing a mature company, right? So I think, fingers crossed, let's keep on working on that. Let's keep on putting together.
I think valuation is more on convincing than on paper, I believe.
And I think valuation also varies from people to people, right? I mean, one valuation doesn't mean that, everybody's benchmark is the same. I think it varies from people to people, no matter whatever the method that you adopt. It varies from investor to investor, actually.
Very good. Very good.
Thank you so much. So with this, CA Nimesh Kampani, thank you so much for sharing your insight and knowledge and experience with all our members. And I think, like, from here, our members will definitely take new dimension to their startup ideas, or probably their investment journey altogether from here. So thank you so much for being here with us. And can we have all big round of applause for Nimesh Company? So
Nimesh, I believe you will be with us till the end, right? Because we have to give you a certificate of appreciation.
I might have to go, so I'll come back. I have a call, so I'll just come back and log in.
Okay, fine.
So somebody is asking
Thank you so
how
much.
they'll reach out to Nimesh. So his email ID was there. We'll anyway share his email address, so you can reach out to him with this. So thank you, C. Nimesh.
And
Now, as we move along, we need to have our next speaker, whom I would like to ask our executive committee member, CA Sheetal Soni, to introduce.
Thank you, Anurag. It's my pleasure to introduce Sanjay Jha. Sanjay Jha is a co-founder and CEO of Let's Venture and My Startup Equity. Sanjay likes to describe himself as a super geek, someone who is only interested in new technology, coding, and as an innovator disrupting established norms. Sanjay, along with Shanti, saw the power of tech disruptions and startup as early as 2013 and founded Let's Venture to build a secure, scalable, high-performance platform to help Indian startup ecosystem. Further, in 2019, Sanjay launched MyStartupEquity.com, a SaaS tool that digitizes captable ESOP management and facilitates ESOP liquidity. With over 2.5 decades of experience in developing software products and building strong tech teams, leadership for high performance and innovation, Sanjay is a true growth enabler. It is my absolute pleasure to welcome Sanjay and share his wisdom and experiences on the topic decoding equity management. Welcome, Sanjay.
Yeah, thank you, Sheetal. And I hope you can hear me.
We can hear you, sir. Very
yes,
clear.
Sir.
Yes. It is an honor to be here at such a large audience and all of you taking time to listen to us. So thank you all. And I'm sure many of you are accomplished people in your own domain. So it is a great privilege to be here and talking to you all. Just a correction.
All of us are accomplished.
Just a correction there. I'm not the CEO. I am the Chief Product Officer, CPO. Shanti, my co-founder, is the CEO. When we started Let's Venture, I was building the product and I was the product guy. And lately, as Sheetal mentioned, 2019, I built the My Startup Equity product, and there I am handling the business aspects as well. So let me share my screen so that I can run you with a couple of slides. But one of my requests would be to make it more interactive if we can. Let me.
Yeah, Sanjay Saab, one thing, if product is there, then only CEO is there. So product is very important.
Right. Okay. So one of my requests is to make it more interactive. Wherever you have any question, feel free to ask me, interrupt me. I like my sessions that way, rather than having me do a monologue and keep talking for long. So
I'm sure we have a lot of questions, and members, please raise your hand so that in between also we can take your questions.
Yes, yes.
The question as we go along.
Yes, yes.
Oh my God.
Excellent. So let me talk about what is equity management we are here to talk about, right? And as Nimesh talked about how the startup ecosystem in India has grown leaps and bounds over the last decade or so, right? And how we have become the number 3 in terms of the startup ecosystem in the entire world. And as you might have heard various news articles, how ESOPs have become such a popular tool among startups, and how much of ESOP is being used to incentivize employees. And therefore, I will talk about ESOPs, and I'll talk about cap table as well. What is a cap table? It is nothing but a shareholding records. And it has details of the funding rounds, valuations, and different kinds of equity and share instruments. You have in India, you have CCDs for convertibles. In US, you have safe notes and such. All these are part of the cap table. On the ESOP side, you have you have a ESOP pool, you have ESOP plan and policy. Sometimes it is called ESOP scheme document as well. This is a legal document that is actually prepared by lawyers to have all the terms and conditions with regard to the options granting to the employees. I will also decode some of the topics or some of the terms for you in case you are not familiar. So when you give an ESOP to an employee, the first thing that is used is a grant letter, right? Which is signed by the employer as well as employee. So grant letter is nothing where, when the grant letter is given, employee receives the right to purchase those many shares. So let us say I give you 100 options grant, then potentially after 4 years, when everything is vested, you have the right to purchase those 100 shares of the company, right? That is what the grant letter means. And that is what options mean, right? ESOP is Employee Stock Options Program, right? So vesting is, as I talked about, vesting could have different schedules, but most often, 25% every year is a very common vesting schedule. And every time the options get vested, employee earns the right to purchase those shares. And when employees actually purchase those shares, that is what is called as exercise, right? So we call it as exercise. Employees exercising the options, and he gets the shares at that time. And next, employee may sell his shares after he purchased those shares. And there is a, it could be through a secondary transaction, or the very common in India nowadays buyback. I will explain that in a little bit more detail later on. And around ESOPs, right, the fair market value is everywhere talked about. It's a dreaded thing among founders, but it is a part of compliance. So I'll talk about that as well. Okay, so let me give you a quick example of how ESOPs work. Let us say there is an employee called Mike. He joined a startup on February 14th, 2018, and he's granted 1,500 ESOPs, right? What does that mean? So it means that over 4 years, like I have seen, you can see the vesting table here. Every year on the anniversary of the grant date, he will get 375 options vested. Right, that means he can purchase those options after it gets vested. Right now, let us say after 5-6 years, the company has grown very big, and the company is allowing its employees to participate in what we call as a liquidity event, when there could be secondary transactions, and Mike can actually sell his options. Right. So first, as per the compliance, he has to go through exercise. He has to get those 300 shares. Let us say if he's choosing to just sell 300 of his vested options, he sells those 300 shares at that time, and then 500 rupees was the exercise price. So he pays 1.5 lakhs for exercising those many shares, and he gets those 300 shares. Now, okay, there's a big part about taxation here, right? I think we'll talk a little bit more detail, but at a high level, 16,500 is the FMV, and minus 500, that is the exercise price that is used as the notional income by the tax department, and therefore he has to pay almost like 48 lakhs, right? You can imagine, right? It's a huge amount.
Tax on 48 lakhs, yeah.
Yeah, tax on 48 lakhs, yes. So about, let's say 30% of that, so 16 lakhs is the tax he may have to pay, right? And the sale proceeds he will get is about 48 lakhs. So basically rest 32 lakhs is his income. So this is your complete flow of how ESOPs work at a very, very high level. So hope this is all clear, right? Yeah, as I said, feel free to interrupt me. I'm happy to take questions anytime. I'll talk about next is what are the various forms of equity incentives. ESOP is just one of them, but there are various other ones that, of course, ESOP is the most popular one as well, right? SAR is coming up because
so Sanjay, I'll just ask you one question on ESOP. So you said
yes.
On the date of exercising the option, the price was 16,500.
Yes.
And on that day, tax authority will put it as your income.
Yes.
But it's not necessary that you have to sell that. So you can still keep it and pay tax and keep it for further appreciation.
Yes, you are right. So yes, you pay tax as on that date. And when you sell, then you'll have to pay capital gains.
Yeah, then 16,500 will be your cost of acquisition.
Yes, exactly.
Okay.
Yeah, very well said. So the different forms of equity incentives like SAR, which is stock appreciation right. What happens in SAR is typically, the appreciation in price of the stock is given to the employee as a bonus or salary bonus. So it is mostly used as a cash settled scheme, and employee doesn't get the shares to own as such. In India, I have seen couple of companies, at least the ones that are coming to my startup equity. Few of the companies adopt SAR, but 90-95% companies are still going with ESOP itself. I don't know what it is in Middle East. I mean, in US, for example, RSUs and RSAs are very popular, right? And the way they differ from stock options is that, they could be, the company can choose to give an RSU where these stocks are sort of promised upfront, and you don't need to pay any exercise. And of course, there could be time-based or performance-based as well, right? And the performance-based vesting can be done with ESOPs as well, right? And phantom stocks are very similar to SAR. They are usually cash-based incentive programs, but linked to equity of the company or equity share price of the company. But one minor difference I found out is that phantom stocks, the appreciation could be actually settled in cash or equity, or at the time of exercise, you could actually get the respective amount of shares as well. So these are the various, and there are a number of permutation and combination of similar incentive programs tied to ESOP, tied to the equity of the company that companies are using or startups are using today. Right. So quickly talking about the cap table, I think that was something we didn't talk about much earlier. Cap table, as I told you, is a record of all your shareholding, shareholders and their shareholdings. And when you typically, these are all managed in Excel sheets. Company go through multiple rounds of funding, and the cap tables get changed. And we have seen startups facing trouble as they evolve and have multiple versions of the cap table. And therefore, we build this product, and we suggest companies to use a product like My Startup Equity, so that being online, the database can actually track your evolution of the cap table, and you can go back and forth and easily see the data at any point of time. Also, a cap table can be shared easily if it is online with all the stakeholders, right? Be it your internal stakeholder, finance team, your internal teams, also your external teams, right? Your investors, and they will get instant access of your latest cap table. You don't have to. They don't have to keep sending me emails. I have a financial record that needs to happen, and then send me your latest cap table, right? All that goes away if you have an online version. And you could maintain a easy reporting with your investor community. And if convertible securities are there, which has its own terms and all that, and sometimes there is a maturity period coming up, and sometimes you might forget when that is happening, the software would actually remind you. So best would be to use an online product for such cap table management as well. Okay, I think then this is probably $1 million question. I don't know how many of you, I think some of the participants I heard they work with startups. I'm sure when you talk to any of the founders regarding ESOP, these are the kind of questions that you will hear them ask you very first thing, right? What should be the size of my ESOP pool, right? What should be the typical vesting schedule? What should the exercise price I should use, right? And should I give ESOPs to every employee, or should I give to select employees, right? All those things, right? And how much should I give to a particular employee? Is it based on his salary or what else, right? And most importantly, or if an employee leaves, how much time do I allow him to exercise, right? Because there is a trade-off there, right? Ideally you should allow them indefinitely, but if you do that, then your those particular options are sort of blocked. They cannot be reused for other employees. So
Sanjay,
I could.
Sanjay, yes. If you don't mind,
yes.
one member, Bhavna, wants to ask you something on this.
Yes, absolutely. Go ahead, please.
Yeah. Hello. Am I audible?
Yes, Bhavna.
Yes.
Yeah, I had a question when you said about this, I agree with you. This is going to be very complex. So I had one specific question on the non-diluted equity. I mean, there are some clauses where founders, some of the founders would like to have a non-dilution clause.
Okay.
So is that taken care of, and what are the tax implications?
Yeah, Bhavna, I would not suggest founders to go for a non-dilutive equity. We have not seen this among the startups that we fund, right? It is very uncommon to do that. I have heard some of the employees talk about it, right? When they get ESOPs, for example, let's say if you hire a CTO or a chief marketing officer and you give ESOPs at a very early stage, and you give them only, let's say, 0.5% or 1%, that 1% could become, probably 0.1 or 0.2% after 3-4 rounds of funding, right? Just to give you an example. So then these are the kinds of people who would say, okay, give me a non-dilutive ESOP, right? But it is nonetheless, it is not common at all. As far as the tax implications are concerned, I'm sorry, I am not the right person to answer those. I know about the ESOP taxation, but in terms of the non-dilutive equity, whether there would be any tax implications, I would not be able to answer. But if you could send me a question, I could get an answer for you definitely.
Okay, that would be great.
Yeah.
Thank you. Thank you so much.
Sure. So just to, how much time do I have, Sheetal?
You've got 12 more minutes.
10 to 12 minutes more.
Okay. So let me quickly go through these things quickly. So in terms of the ESOP pool, I mean, there are you could have different size of ESOP pool depending on the stage of the startup, right? And a very typical one, if you are running out of any number, then you could use a 10% as the size of the ESOP pool to start off with. And of course, you can top it up during different funding rounds. Exercise price, we typically recommend that let it be your face value of shares. So of course, some companies try to tie it to the previous round of share price, right? And in terms of the last question, exercise period, we recommend that startups use something like a liquidity event kind of process where employees can exercise their vested options at any liquidity event. So that becomes a win-win situation for both employee as well as the employer. In terms of the employee, he gets to exercise the ESOPs and sell it immediately. Therefore, he doesn't have to pay out of pocket the tax part. And in terms of the company, the employee doesn't come onto the cap table because immediately he's selling shares to an investor. So that's what we recommend. In terms of compliance, I think many of you would be familiar with this, so I will probably skip it. But quickly, I mean, when you launch your ESOP scheme, let's say in a startup, you need to get your ESOP scheme prepared by a lawyer, get it approved by your shareholders, and at the end of every year, you need to put your expense related to ESOPs in your P&L and file disclosures in your audit report as well. And all these are, I think, depending on the country to country. I think US and Singapore and India all has different formats for these, but all these have to be done in some way or the other in each country. In terms of accounting, I think all of you are probably a master of this compared to what I'm speaking. So there is intrinsic value approach for ESOP expensing. There is fair value approach where intrinsic value, it is based on the share price and minus the exercise price is used. And in terms of fair value, you use the Black-Scholes or some model to create the option value directly and use that for your ESOP accounting. Again, the expense calculation is dependent on the whatever policy you are using for your accounting. In India, I have seen companies use both straight line method as well as the front loaded method called graded vesting. In straight line method, every year, the same amount of expense is added into the books. Whereas in front loaded method, first year, a large part of the expense, let's say 53% is added. And then later years, a smaller portion is added. So And most of the larger companies I have seen use front-loaded method, whereas smaller companies will go with straight line method. And same process applies in Singapore and US as well.
Yeah, so basically it's IFRS 2, shared based payments.
Would you like to take one question, Sanjay, now?
Yes, yes, absolutely.
Yeah. So Sunil, I'm unmuting you. Please go ahead, Sunil.
Yeah, hi. Hello, Sanjay. You have given a very clear approach and it's very informative. My question is there, like you mentioned in the previous slide, there are 4 methods are there. One was ESOP, one was SAR, something you mentioned about the US. Because
yes,
I'm
RSA and RSU. Yes.
I'm following similar in my startup, basically.
Okay.
I am giving that. So I would like to know more on that how that would be in the interest of the company and the person who is getting associated with my startup, how I'm going to can add value to both the company and the person, because I'm following that methodology basically.
What is your exact question? Sorry.
My question is that method which you mentioned about the US, which is based on the milestone and the performance.
Okay. Yes, yes, the RSA and RSUs. Yes.
In my startup, basically. Okay,
yes.
Are associated or supporting us or like helping us out.
Right.
I'm following that, man. So can you just throw more light which can help us basically? I would like to know how this help a company and how this can be a value addition to the person who is helping the company also at the same time.
Yeah, so RSA, think of RSA and RSU as just another form of equity-based incentive. It is again given to employees, advisors, consultants, anybody, right? And these are all time. It could be time-based. So again, RSA also or RSU could, for example, be a 25% vesting every year for 4 years, or it could be saying that if you give us this milestone, if you are a sales person, you need to get me a 1 million ARR. And then you will get this, this particular vesting. So all those things are very similar. RSAs and RSUs are different compared to stock options in US, for example, in terms of their tax implications and in terms of their, compliance paperwork, etc. But in terms of
R stands for restricted.
Yes.
So
yes.
Once
so
this
that restricted. Over, yes. Go ahead.
Yeah.
So what does that restricted stands for?
The restricted stands for, again, the time-based restrictions or performance-based restrictions, right? Those kind of things.
Is it a well-accepted model in India, or is it among the angel investors or venture capitalists? Like if I'm agreeing with somebody already at this level, that right. Okay, I'll be giving to the consultant or advisor this much percentage of share on this milestone, for example.
Right.
Will this be acceptable to the angel investor or the venture capitalist who will be coming later on to the Series A funding?
Right. So you are talking about advisor equity here, right? So where, let's say I have an external advisor and I am trying to give him advisor equity. Typically in India, there is a, as per the law, you can only give ESOPs to full-time employees, right? So therefore, if you need to give advisor equity, you need to give them straight out of your cap table, right? And yes, angel investors are willing to bring advisors on board. I think Nimesh talked about Let's Venture also. We have many advisors on board. We have given them advisor equity. And it is a very common practice to give advisor equity. How much you need to give and what should be their contribution, how you will measure that contribution, how long they are going to be engaged with you to earn that full advisor equity, all that is a something that can be discussed with the board and can be decided. It all depends on what kind of contribution the advisor is going to make and for how long is he going to.
Thank you, Sanjay. Thank you very much.
Yes. Okay, so we talked about ESOP accounting and the taxation also I had briefly touched upon. At the time of exercise, you have the exercise tax, and that is deducted as a TDS. And at the time of sale, there would be a short-term capital gain, or if you have, if you're holding the shares for longer than 24 months, you can pay the long-term capital gain. Okay, ESOP liquidity. This is another important part. I think many of you must have seen some of the large companies allowing employees to sell their ESOPs and get it in cash, right? And there are two ways to do it. One is ESOP buyback. In terms of ESOP buyback, what happens is, the company is spending money from its own balance sheet, and they are buying back shares from or other ESOPs from the employees and giving them cash. So the entire ESOP gets cancelled. Let's say employee had 400 options and 100 got vested. Those 100 options would get cancelled, and the equivalent amount of money will be given to the employee. And I have given examples of BlackBuck, Razorpay, and Academy, which has done ESOP buybacks. Secondary sale is where there are external investors who are brought in to buy those ESOP and after exercise those shares, and that is what happens in terms of secondary sale. Flipkart had done lots of secondaries, but mostly they were clubbed along with primary rounds. So they would allow every primary round, they would allow a number of their employees to go and sell part of their vested options and get the equivalent amount of money. And these incoming investors, as part of the primary round, they would also buy this ESOP shares through a secondary sale. And of course, last but not the least, I mean, when the IPO is happening, everybody gets encashed, not from the founder, employees, investors, everyone, right? But it's a long wait. So we typically want to see startups provide regular ESOP liquidity, and that is one of the things my startup equity solves for, is to provide regular liquidity options to companies. Let's say every year or every 6 months, you can go ahead with that, and our company, Let's Venture, would manage all of that for the startup. Okay, the last slide I would leave you with is kind of a success story of how the ESOP story at Flipkart has played, a gigantic role in terms of launching multiple companies. This is the Flipkart mafia, so to say, you can call it, right? All these names that you see here, they are all founders, or they are all employees of Flipkart, and they went ahead. They had ESOP liquidity, and they made money through ESOPs, and they went ahead and founded several companies, right? The Udaan founder, for example, the PhonePe founder, the Exotel founder, Runner founder, CureFit founder, right? All of these guys came from the Flipkart mafia, and probably most likely that because of the success that ESOPs generated for them in terms of giving them many-fold returns or exits. And you can see on the right side that the success story at Flipkart in terms of ESOP was that the ESOP pool was topped up regularly at every round. They provided ESOP liquidity in terms of a buyback every year. Every time there was a primary, they would offer liquidity to their employees. I think some of the numbers are there. There were 100 million buyback in 2017, 2018, 100% buyback up to 100 million, 800 million, 100 million buyback in 2019. So huge incentive and liquidity events happened in Flipkart, and the wealth generated for these employees help create the Udaans and PhonePes and Runners of the Exotels of the world, right? And most of these entrepreneurs who made money through ESOPs are today ready to fund new startups, many of them through Let's Venture as well, because they have seen or they have tasted the blood, you could say, right, where they can see and they can firsthand evaluate good startups right on day one, and they are willing to bet and put large checks to invest in those startups at early stage, so that that's how the ecosystem grows many-fold with power of equity, so to say. So that's about it from me. You can reach out to me at sanjay@letsventure.com. Our product is at mystartupequity.com.
Thank you, Sanjay. It was a wonderful presentation. Is there any questions? I don't see any hands raised, but I'll ask meantime a question until we see the next hand raised. You mentioned about in your profile also the liquidity that you provide and that you try to provide for ESOPs and the so how do you do it, and to what extent that is because that's one of the key element that we do. These equities are private equities, these are not liquid. Once you are in, you are locked into this. So how do you provide it, and how much success you have seen in it so far?
Right. So actually, Nimesh should be the best person to answer it, because he runs that part of the business for us. Where in fact we did very recently, a large for a unicorn startup. We did a ESOP liquidity event which got subscribed many times. At Let's Venture we have access to lots of family offices and ultra HNIs, and that's what Nimesh runs for us. And when you on the other side, you pair up with a large unicorn startup where employees are holding lots of ESOPs, and we bring the two together and we make sure that all the paperwork is done, the entire burden is taken away from the startup management, and we run the entire event end to end. And that's what we call as a ESOP liquidity program.
Thank you.
Well,
thank you very much.
Well said, Sanjay ji. Now we have another question from CA Hossain Sadri. I'll ask CA Hossain, you can unmute yourself and ask a question. CA Hossain? No, he's not.
I think he got stuck. Yeah, now he's.
Iskandan Mahalingam?
Yeah, Hussain is there online.
Hello. Yes. Mr. Sanjay, I am audible?
Yes, you are.
Yes, Mr. Sanjay, my question is from the point of view of an angel investor. I want to know that what should be the return which an angel investor should expect in the short term as well as long term? Because if I expect too much, then it is very hard on the startup. That it's a new venture and I'm expecting too much. And if I expect too less, then I am wasting my investment. So I want to know what is the a range that we should expect.
Yeah, I would give you a short answer. One is that you should hope for the best, but prepare for the worst. So that's how startup investments could go. I have personally talked to angel investors who have got 10x returns, sometimes 50x returns, right? But there are many angel investors who would have lost money as well. So that is why Nimesh was talking about that if you diversify your investment and create a larger portfolio, then you are better placed to get a sizable return at the end of the day. But otherwise, at an angel stage, I would not put any bets in terms of what kind of returns you should expect. You should hope that the company becomes big and unicorn, and the returns would follow. I think every effort that an angel investor makes is to make the company big and help them raise next round of money, help them reach next level of scale, and returns will follow. I think what exactly could it be? It could be Flipkart, or it could be $100 million exit. Whoever knows. Who knows?
Okay, so we have another one question we'll take before starting the session. Mr. Suresh Mahalingam. Sir, go ahead, please.
Yes, now I'm unmuted. Thank you very much for a very illuminating subject. I have a practical question, very topical one. This morning I was asked by an investor how he can release value on options in his startup for his employees, but the startup is not in India, it's in Seychelles. So is your service available to overseas startups as well? Singapore registered, Seychelles registered, etc.?
We plan to do that. We have not executed any transactions outside of India yet. It is something that we plan. I would suggest you reach out to me or Nimesh. You can see whether this would be something that we can take up or not.
Very well. Thank you.
I think Sunil Mirchandani. There's a question from Sunil.
Sunil, you can ask, unmute yourself. If you have a question, yeah, please.
Hello.
Yes.
Yes. Sanjay, just one thing which I would like to appreciate, your one statement which you mentioned, that ESOP is not just a money on the paper. That's a very nice statement actually. And I would like, I hope that everyone would understand this, that getting associated with startup is just not just a paper money now anymore.
Yes,
just wanted to say that. It's a really good statement.
Yes, I think that is very important. As Nimesh also talked about, the startups have grown in India, and you actually see the paper money turn into real money at a very common, very regular intervals nowadays, right? Many big startups are regularly providing ESOP liquidity to their employees, and employees are making lots of money buying big cars and houses and stuff. Of course, you need to be working in those big companies, but good to see that happen, right? Because 10 years back, like you said, it was just paper money, and employees would get worried saying that, hey, I want more cash compensation rather than ESOPs, right? Can we talk about that? Right.
True.
So I think now ESOPs are truly valued and play a bigger role in terms of incentivizing employees, and employees are also appreciating it, right? So both ways it is helpful.
Thank you very much.
Thank you so much, Sanjay Jha sir, for sharing your insight on the equity part on the startup. And I think it's very eminent for members, and it's really very beneficial for them to understand that how they shall plan their equity and how they can really involve the employees in terms of getting the entire growth. So a round of applause for Sanjay Jha ji.
Thank you all. Yeah, thank you.
Anurag, there's a question from Kalai Mano. Do you guys want to take it now?
I think we are already 10 minutes late, so let's move to the next session.
Okay.
So now I would like to ask our treasurer, C. Harikishan Rankawat, to introduce our next speaker. Over to you, Hari sir.
Hi, good evening, friends. Next round of speakers, CA Vikas Wadhwan and Sina Tenugara, are going to have a joint session on success stories of Indian unicorns. I always believe in ladies first. So let me introduce first Sina. She is working as Chief Brand Officer at Let's Venture, a startup investment platform. At Let's Venture, Sina is building the next generation of experiences, content, and community to help deliver the promise of Let's Venture to its customers, founders, and investors. Sina was formerly an anchor and features editor at CNBC TV 18 for 13 years. One of the big areas of her work was producing India's longest running show on entrepreneurship, CNBC TV 18's Young Turks. She has also co-authored the books Young Turks, Inspiring Stories of Tech Entrepreneurs in the year 2014. Now I am pleased to introduce CA Vikas Wadhwan, who is working as a group CFO of PropTiger.com, Housing.com, and Makaan.com. Vikas is a chartered accountant from India and a certified public accountant from Colorado, USA. Vikas joined PropTiger.com as part of the founding team in the year 2011 as CFO. He has got more than 17 years of extensive experience in M&A, fundraising, capital structuring, taxation, risk management, investor relations, and legal secretarial work. He was selected as part of CFO Power List in the year 2019 by Core Media Group, and he was also awarded the title of the Young CFO of the year 2018 by Economic Times Now, and the Stars of the Industry Award for Tech Startup category. Ladies and gentlemen, now I welcome CA Vikas Wadhwan and Sina for a fireside chat. Thank you.
All right. Thank you very much, Mr. Rankawat. An absolute pleasure to be here with all of you today. Just as a continuation to the conversation that we've been having, you will all be very interested to know that Vikas was actually part of the founding team at PropTiger, correct? And of course, he has grown into the role of CFO of the entire group now, which includes Makaan.com, Housing.com, and a lot of other entities. Vikas, you want to first, before we dive into the conversation, just tell us a little bit about your own experience with ESOPs and your own experience with equity. What has that been like? How has that worked out for you?
No, so I think this is a very pertinent question at the right time, I would say, because I don't know if how many of you know or not, but we've recently bought out by REA Group. So whole of the company is bought out by REA Group, and we are a subsidiary of REA. We are no more a venture capital backed or private equity backed startup. Yes, the journey or the ESOP was an exciting journey. We've been waiting for that for so long, and at the end, or I would say not at the end, but possibly at the beginning of a new start, we got, as Sanjay rightly said, ESOP is not just a paper money. We got the color of that.
Yes, you have got the color of that. That's wonderful to know, Vikas. So tell us a little bit, right? You started off as a CA, you joined, PropTiger at that point of time with Dhruv and the early founding team in 2011. Tell us about those early years, right? 2011, startups were not very buzzy in India, right? What made you take the move and take the plunge to join a young real estate technology company? And tell us a little bit about growing from, growing into the CFO's role at this company, which is now really quite large.
So for that, Saina, I'll take you one role back before PropTiger, in fact, because I worked with another startup, and that was in 2007, even before 2011, when startup was not a buzzword at all. Today, people feel proud that, oh, I'm working with a tech startup. I still remember, I was part of consulting. I was working with Grant Thornton before taking my plunge into startup ecosystem. And I still remember my conversation at my home that I'm going to join a startup which is in Gurgaon on top of a factory, and there are only 25 people working. And my wife and my parents said, "Are you serious?" I said, "I don't know whether I'm serious or not, but I feel the opportunity is very exciting." And when I look back now, frankly, 13 years down the line, 14 years down the line, I think that was a very right move for me as a professional. Now, looking at my journey in PropTiger since 2011, the journey has been very, very exciting. As a founding team member or as a member of the team in early days, two things are very, very important. I would say these are fundamental to your approach if you're joining an early stage startup. One is agility, and two is the boundaries are very, very blurred in terms of, so if you're joining as a CFO, don't assume that you'll be continuing to work as a CFO in the early days. So when I'll give you an example. When I was I joined as a CFO, and in the early days, I wore the hat of a head of HR as well. I managed operations. I did a lot of business development, and that's how the early stage of the startup is. And I frankly love doing that. So that's very, very important. And also you need to be very, very agile in your approach, because the problems are very unstructured. You do not have systems, you do not have experiences to actually look back and say how to solve it. So you need to be very, very agile in your approach, make mistakes, learn, and then implement that learning. That's how the startup journey is.
Okay, because as you were building out the team at PropTiger, right? I mean, and I know that as an early employee, you would have done a lot of different things like you explained. But within the finance function and within, the CFO's office, how have you gradually built up the team structures, brought in, maybe product, technology products to help you execute better? If you can give us a sense of that, right? As the company matures, how do you think, or what are your learnings on how the CFO's office or the finance, segment of a young technology company should also keep growing? Correct? Because, business teams grow, marketing teams grow. How does the finance team need to keep up with all of this?
Yeah. I would say that my experience or the learning in this last 10 years.
Because you're mute. Looks like I cannot hear you.
Can you hear me now?
Yes, we can hear Anurag.
Yes, we can hear.
Yes.
Okay, perfect.
Anurag, yeah, we can hear. Yeah, please continue.
Yeah. So this was quite a learning experience, frankly, Saina, for me as a professional. And I still remember that when we started PropTiger, my team was a 4-member team, and I was the only chartered accountant in the team. And we were doing most of the stuff on Excel-based working. Even the business tracking, at least for the first 3 years, was happening on Excel sheets. That's the kind of journey. But I think very, very important, as I heard that there are quite a few people who are doing their own startups. I would say one very, very important thing, which I've seen in with a lot of my friends as well, that they feel that finance or compliances as a non-critical function in the early days. But I would say it's all the more critical in early days than in the later days, because by the time you are in Series C, Series D, your investors will force you to do that. But the mistakes which you would have done in your early days, it takes a long time to correct. So even if you set up a small team, set up a lean team, set up that team, have that team in place. In terms of my journey building the finance team, as I said, we were a 4-member team. We were doing a lot of stuff on Excel. But once we got a little stable, I spent a lot of time and energy with our tech and product team in building the right platform, the right processes and systems for finance. And that was not completely focused on finance and finance controls, but also focused on how do we bring efficiencies into the business. So if today my customer is getting invoice in, let's say 30 days, 15 days or 10 days after the services are delivered, how do I make sure my customer gets invoice in 24 hours or possibly on a click of a button? So that's the kind of focus we kept. And today we are a 25-member team. The team is well structured, verticalized between controllership, finance, business partnering, and taxation. And I can confidently say that if tomorrow I'm not in the system, my team is very well settled and they can take the rein forward.
All right. Taking this conversation forward, Vikas, on building in efficiency into the system, over here, you're also not working just like you said on the finance role, right? You're coordinating closely with business teams. You're coordinating closely with the product team. So if you're working on getting invoices to customers faster or bringing efficiency into the business, we should not, in a startup environment, think of it as a siloed role, correct? You're not just there at the end of the year to look at, the profit and loss statement or file some forms with, the different ministries and so on, correct?
That's right. No. So that I would say, Saina, that's not only for startup, but rather I think the role of a CFO has completely evolved. It's no more a corner room office where the person is just looking at the P&L or looking at the MISs and matrices and so on and so forth. This is a very, very business critical role. This is more of a business partner rather than more of an accounting or a finance professional. And that is the DNA which I believe is very, very important for any finance function to build. That's very important.
Okay. All right. One question, Vikas, and over here, I'm actually going to quote something that you had said in an interview earlier. I think you were asked what is one of the most overrated financial advice that you ever got in your career. And I think what you had said, and I'm quoting you over here, is to focus on expenses. While it is essential to keep a close watch on the costs, but to grow your returns, you also need to think of or focus on the growth of your revenues. Can you tell us a little bit about why you think this is important? And can you maybe also illustrate this with an example from the PropTiger story, right? We keep hearing this, startups are cash guzzlers, VC money is being burned and all of that. But somewhere you also need to spur that growth, correct? So tell us maybe in the context of PropTiger itself, how you have managed to balance these two out.
No, absolutely. I would say you're quoting a very, very, very old discussion, and that's the risk when you're sitting on the other side of the table with an editor. So you're always well researched. So, but thanks for reminding me. But this is not just a quote, Saina. I would say rather this is the philosophy or a guiding principle for the finance function in our organization. And when I say this, see. By no means I'm saying cost is not critical or cost is not important. Cost is very, very critical. You always need to be cost efficient for any business. But I think the hat which you need to wear whenever you are making a business decision or whenever you are making a decision which comes to you as a CFO, you need to wear the hat. What is the business impact of that decision? It's very easy for anyone in finance function. And I think all of you guys here in this discussion are much more experienced than me, it's very easy for all of us to say, oh, we do not have budget. We can't support this decision. I can't allocate additional capital for this. But I think more important is to step back, see what is the business criticality of that additional funding requirement or that additional capital allocation is, and see how we can arrange that capital if it is very, very critical for the business. Because at the end of the day, you can make your cost efficient to an extent, but revenue growth is something which will going to make the business very, very successful and make the business more profitable, right? I'll give you one or two very, very small example, and that is the example of my business partnering team. So the business partnering team which I have, every time they are looking at a decision. So let's say if business brings a decision of a new incentive scheme to the guys, the guys will not going to look at only whether we have the budget to support that incentive scheme or not. The guys will run the simulation, see how many people will qualify for that incentive scheme or not. If that qualification criteria are not stringent, that it makes people demotivated for that incentive scheme and it doesn't excite. Because if you roll out an incentive scheme, make it very, very tight, which makes people completely demotivated, then better not have that incentive scheme. So that's the kind of approach we take whenever we make decisions, or like pricing discussion, whenever the product pricing discussions are happening. So that's where I think business partnering and focusing on revenue growth or focusing on business growth is more critical than cost.
All right. So, this actually makes me reflect on a conversation I had had some time back with another CFO, right? And I asked him to and it was a very young audience of entrepreneurs who were there at that time. And I asked him to describe what is his day, what does he do in a day? And he simply said that I'm a storyteller. I look at Excel sheets and I look at my product, and then I find the story that I can go back and tell my different team members to kind of help them think about how they are managing costs, how they are managing expenditures. And he said, if I don't tell a story, I'm not relevant to this organization. So Vikas, in your own journey, right, how important has this storytelling of, looking at the numbers and spinning? I'm not saying spin doctoring, but what I'm trying to say is, making it relevant so that different teams can understand the, sort of the intricacies of what you all are doing for the organization.
Very, very pertinent, Sarah, and you rightly pointed out that storytelling always have a negative connotation as well, and especially when you say, okay, CFO is doing the storytelling, that's always seen as a negative thing. But frankly, we do storytelling a lot, and I'm sure all the people who are on this event, they will be able to relate to that fact. See, it's very easy to present number on an Excel sheet or an MIS or in a PPT, but unless you tell the story behind those numbers, in a particular month you may have, or in a particular year you may have achieved only 10% growth, which is not at all exciting. But you tell the story behind why 10% growth, and tell the story behind, okay, revenue growth is only 10%, but there are many other areas where you have done much, much better, which are the lead indicators and probably translate to 40%, 50% revenue growth next year. That is what also called storytelling. That's an external thing, but even internally, so right now we are in our budgeting process, right? You look at the numbers, you're trying to kind of map to two different ends where there are certain expectations from the investors or the shareholders, whereas there are certain expectations from the employees. You look at the budgeting sheets, and then you go back to respective departments, to respective business heads, and tell the story that what is going wrong, how can we make it right, what are the pockets where there are opportunities. Because presenting numbers does not help. Presenting numbers is I mean, we all can read that number, but it's important to explain the story behind that.
Okay. All right. I'm going to request all the members, actually, if you all want to put in some questions, you all can do that. If you all want to raise your hand and participate, please feel free to do that. And while you all do that, I'm going to ask, one more question. And this is actually...
If you allow me one question,
Sure, Anurag, go ahead.
So Vikas, when you say about storytelling and you talk about the role of a CFO in a startup journey, I mean, we are working with a lot of startups here, in terms of a lot of compliances. And we have seen one important factor that, the person who stick around in the very outset, in the beginning of the part itself, his role as a CFO plays a very important aspect in terms of planning your global expansion. So if you can share some of the story with respect to your global expansion, how you have helped the entire business and what is the key role that you played? I mean, I'm interested to hear about your key role that really helped the startup, your business to really optimize the right value for its preposition. Yeah. I mean, how did you really help actually?
No, Anurag, good question, I would say. Anurag, we are not a global company. While we are based out of Singapore just as a holding company, but the entire business operations of the company is in India. In fact, a couple of years back, we ventured into Dubai, but it didn't work out for us, and we had to take a tough call just before the COVID period. So we are not a global company, but how do I participate with the business, or how do I kind of drive some of these things at the forefront? I spend a lot of time with the business. So if, as Saina was also saying, how does your day look like? Before COVID, my usual calendar was that every month I had to spend 3 days traveling because we have a pan-India presence, right? And I used to go to one city every month and meet the local business guys there. So the guy who's leading that city or the guy who's leading that region, I would spend the whole day with that person, because while sitting in my head office, I can paint my south region and my west region with the same brush. But the challenges, we all know, India is a combination of at least 20, 30 different countries. South behaves very differently. Even in South, Chennai behaves very differently than Bangalore. So unless you go to the ground, talk to the people, understand their problem, you will not be able to appreciate what they are doing. That's one part. Second, I also spend a lot of time with our customers. So whenever I go to a city, I actually plan my visits to the developers who are our biggest customers. I go down, go to the market, meet the brokers, just random visit, because brokers are always small shops. They don't care whether I'm a CFO or I'm someone else. I'll just go with the sales guy, just try and see what kind of sales pitch they're making. What are the tough questions the broker is asking my sales guy? Because unless I understand that, I can't actually wear that hat while making some of the decision in the company. So that's how I participate at the forefront. Okay. Hope Anurag, I have answered your question.
Okay, so while Vikas, there isn't much global expansion to talk of, Vikas actually led two, maybe many more, but two definitely very high-profile M&As in India, right? Where PropTiger acquired Makaan.com and Housing.com, both very popular and big startups in their own right, correct? Talk to us maybe your learnings from the journey of conducting those M&As, right? What was the thinking? What did you drive within the organization? What were some of the tough questions that your investors asked you? Because, acquiring these companies that had relatively higher valuations at that point of time, that were in the same space, what was, some of the tough questions that came up that landed at your table for you to answer?
So you asked multiple questions in the same question, but let me just try and cover as much as possible. Biggest learning for me from these acquisitions, Saina, was an acquisition is as good as the post-merger integration of that acquisition. Why we did these acquisitions? Because PropTiger, when we started PropTiger, we were focusing on a very, very niche of the overall real estate landscape. We were a digital real estate broker, so to say, right? Where we were tying up with developers, helping them market using our digital and technical capabilities online, generate as many inquiries and leads for the customer, and then try and close those leads into sales using our own sales force. So that was the PropTiger business. But then 2013 onwards, the new homes business started facing challenges in the market, and we started seeing our growth tapering down. And that's when we actually gone back to the whiteboard, we said, what can we do in the real estate digital ecosystem? And then we said we have no option but to expand the platform to resale, to rental, so that we can cater to the audience across the spectrum, not only the people who want to buy a new home from a developer. And that's the rationale when we acquired Makaan in 2015. And post Makaan housing, the board or the investors, they said, oh, you just acquired Makaan in 2015 and you've been investing in rebuilding the product, rebuilding the platform. Now you're coming back to the table with housing acquisition. Why do you want to do that? And that was an interesting conversation. And I'm sure most of you have heard stories about housing. So there was another angle to it. Why housing? Are you sure you want to do that? Because there were all sorts of.
It was a very notorious startup at that time. Yes.
I mean, I don't use that word, but yeah, I mean, it was media caught a lot of negative attention for that business. But I think we were very, very clear in our mind that the tech and product capabilities for housing were really very good, right? And the brand was very, very young brand. And if we look back, the brands which were existing in the market, they were like 2004, 2005 era brands. We were like getting kind of old in terms of the customer recall. So that's the big rationale why we acquired housing. And very, very important 2-3 things. If I just take another minute or so, for an acquisition, you need to look at the team. You need to be very, very careful during the diligence process. And team, why I say team, because in tech startup ecosystem or digital ecosystem, it's the team which you bring to the table. Otherwise, you're not doing an industrial acquisition where you have manufacturing lines,
some assets, right? Some physical assets to acquire.
Tangible assets in a digital acquisition or a tech acquisition. So team becomes the biggest asset behind it, right? So you need to look at team. You need to look at you need to do your diligence properly, and then post-merger integration, as I said. And you can't do this unless and until you're very, very clear in your mind what are the objectives of that acquisition. And if you know what the objective of that acquisition is, then these things can fall in place.
Okay. I will take a question that comes from
Saina,
yes.
And if you allow, I have a question. So, okay, thanks, Saina. Because see, as a CFO, there's always good, as you said, to tell the story. That's fine. But we always love to see the green signals, either in the revenue side or the cost side or positive, like less of the cost. But in the startup, it's always on the red zone. So when the conversation happens with the CEOs or you can say the investors, so what story comes up in the play? Like you clearly mentioned, lag indicators and lead indicators we'll look at, but it's not a 1 month or a 2 month story. Sometimes it goes for years also. Absolutely. So how the CFO can motivate himself continuously saying that, okay, numbers are bleeding, but still we are working good.
Yeah, Rajiv, very, very, very good question, I would say. And frankly, our journey was full of, because real estate in India has been very, very tough for the last 4-5 years. See, Rajiv, what is important is it's not as if that you only see red, right? Even in startup. So I always look at my P&L in 2 ways. Yes, the bottom line is red, but are your unit economics positive? Are you seeing green there? If that is not green, that is the problem. And that is where I spend my focus, energy, and time to make sure that our unit economics are positive. And then the bottom line is negative because we are investing either behind the product or behind the brand or behind the technology, right? If you're investing behind these things, then that red doesn't raise a big alarm. And that's what you need to explain to your whosoever it is, whether it is CEO, investor, employees, till the time you can present that picture that you're investing for the long term, but your unit economics are positive, then it's all good.
Okay. arriving at the unit economics question itself, I think, can be a whole different conversation that ICI Dubai can host for us, right? How do you arrive at unit economics? But I think, Anish, you have a concluding question. So
Yeah, I know one of our members have the concluding. We should give members more opportunity.
I also have a question, Anish. Can I?
So, yeah. First, let us take Ashok and then Sangeeta, you can conclude.
Sure,
Ashok,
thanks.
if you can please ask your question.
Thank you very
Ashok
much.
Mengi.
Thank you, Anish. Vikas, really amazing session. And I must say that in such a short span, you spoke really by heart and explained in detail. A quick question to you. In your journey as a CFO, you must have gone through and so many opportunities must have came. What are your learnings which has impacted the valuation of the company positively and negatively? You did 2 acquisitions, right? But these are not the only 2. You must have rejected also, there are a few. What are the reasons of rejecting those ones? What are your learnings? That's what I'm trying to understand.
Vikas, Ashok has changed the question a little bit. He wanted to ask you what mistakes you have made, but he has twisted the question now.
He's being very diplomatic, so I will ask you, what is the big mistake you made, Vikas, and because you're learning from it?
I won't mind that. I won't mind that, and I can expect that question from Ashok. So let me say, good to see you, Ashok. Good, thanks for joining the session. We are actually childhood friends. We did our CS together. So let me answer the first question first, which is the yes, when you so we did not do 2 acquisitions in the last 5 years. In total, we did 6 acquisitions, and 2 of them, yes, Makaan and Housing did really well, but there were 3 smaller ones which also did reasonably well, I would say. They did not become very, very big, but I think the expectation was also not to make it very, very big. They are just the incremental product in the overall bouquet of services. And at the same time, yes, we did mistakes. We did a couple of wrong ones, which did not turn out well. But they were, again, very small, not the bigger mistakes, I would say. If I look back, the recent example where I always repent may be a strong word, but I always question my judgment a little bit, that why did I give a go ahead for that, was, and I'm sure it's a ICI Dubai chapter, so I shouldn't be saying that, but going to Dubai was not a good decision for us in 2018, because Dubai market was not doing well, and we were not very strong as a platform in Dubai. We always thought that we can do very, very well digitally in Dubai, but we couldn't do well digitally in Dubai. And that decision came to the table multiple times, 2015, 2016, 2017. And I was the one who was always pushing it back. No, we should not do. But that 2018, I don't know what happened. I said, okay, let's go ahead. And but that's fine. I think I would say that's the life of a startup. We all do mistakes. The important thing is, one, we should not hold those mistakes against anyone. So if the business did not do well in a particular region, or a product did not do well, let's just move forward with that. The entire idea is take quick decisions, fail quickly, and then learn quickly, and then move on.
Vikas, I think one mistake you have done, that you came to Dubai and you didn't become member of ICI Dubai chapter. So
Anish, I have worked in Dubai as well. So,
great.
In 2005, I worked in Dubai with Grant Thornton, and Ashok was also there, and we had a gala time.
Ashok was in EY that time.
Ashok was in EY at that time. That's right.
No, Vikas, one more thing on a lighter note, right? Since you are childhood friends, you still have some hairs here, since you are not in Dubai, compared to Ashok. So
That's true. But I'm actually on the same track. Don't judge my age with that. Probably I'm losing hairs.
Great, Sangeeta ji, go ahead.
Yeah, because I am from the development space. All my career have been in the development industry, and really excited to hear your journey on the digital marketing of the properties. See, we have very strong partnership with propertyfinder.com, and today as a developer, we sell most of our properties through propertyfinder.com. So actually my question was slightly different, but it changed because I did not know that you guys had ventured in 2018 and did not see so much of success. So I'm really curious, why exactly did you guys fail? Maybe it was because 2018, the property market wasn't that robust. Was that the reason? Or was it something else? And yeah, mainly it was like, my initial question was, why don't you guys, is it possible for us to have a relationship with you guys if we are planning to market our properties back home? Would there be some kind of partnership avenues? So my question is on that line.
No, so Sangeeta, I'll answer both the questions. I think our recipe for Dubai was not right, possibly, as a candid acknowledgement. And I won't go into the detail, but I think we were focusing a lot, which I mean, as a digital real estate platform, we are a company which is focused a lot on Indian resi market, right? And we thought that possibly we can take Indian products to Dubai or other Middle East regions, and Dubai could be an entry point and sell that. But because of many reasons, our cost, that unit economics didn't turn out well. That's one issue. Second, when I say recipe, possibly if we could have had more mix of selling local properties and less of Indian properties, then we could have made money.
I guess, yes.
Economics.
Because I'll just say one thing here. You are not the only one who suffered in Dubai. We can write books of what not to do in Dubai real estate, right? And still figuring out what to do. So don't worry about it.
Yeah, but I was very impressed by your, your approach of speaking to the sales guys, brokerage guys, being on the ground, understanding the business. No wonder you guys have done so amazingly well, because I mean, in India, yeah.
But would love to kind of partner with you.
I was wondering if we could list our properties there, and we'll get in touch with you. Yeah.
Absolutely.
Happy to facilitate that. Anish, you can help me help.
Don't forget to support the chapter as well after their deal.
I think our time is completely up, so I will hand it back to Sheetal. I will only say that we would love to come back sometime and do a deeper discussion on unit economics. Correct? I think this is at the heart of a lot of startup related conversations, and I think it would be particularly insightful to this group. Thank you very much.
I'm conscious of time, but I think first time today, one of the past chairmen has also raised hand, so we need to take his question. Pankaj, are you on?
Go ahead, please go ahead.
There?
Pankaj, kindly unmute yourself. Please unmute yourself.
Yeah.
Am I there?
Yes, yes.
Pankaj.
Yes, Pankaj. Yeah, you are there.
Hey, thank you. Vikas, it's an excellent presentation and excellent journey of what you have shared. And I'm proud to share I'm one of the first start of ICICI HFC in way back in 2002 and 3 when the housing industry started in India. And of course, being part of Dubai chapter now and being the past chairman. So my quickly in lieu of time, very quickly that when you, any startup when they're building the team, while of course the founders and co-founders are investing, I'm also seeing a new trend where even the team where it's a CTO or head of marketing or CMO, where you're giving the ESOP, but you're also been to bring a skin in the game and bringing the alignment of the interest. They've been also asked to invest in the startup. So while they get an ESOP or while they come as a co-founder or a CMO, they also need to invest 20 lakh, 30 lakh, 50 lakh. So what is your viewpoint on even they may not be co-founder, or they may be the co-founder in the next round, but they making a skin in the game and investing in the company? I just want to know your viewpoint. Thank you.
No, very pertinent question. I think it's all about how you manage employee equity. See, I've heard very I would say it's not very often then when you expect the employees to invest into the company. It is generally the founding team who invest into the company, the initial seed capital or whatever, that bootstrapping, which we call. But more often than not, Pankaj, what happens is that when you join and you need that skin in the game at the leadership level or at the senior level, you typically expect those people to take more equity and then come into the company at a salary which is much lower than the market. That's how you kind of bring skin in the game, because if I'm working at a, let's say 50% of the market salary, it's a kind of investing it back into the business, right? And taking more equity. So I'm putting my mouth where my money is, right? So that's the typical model which people follow. But I've very rarely heard when people expect the employees to invest into the company.
Great.
Pankaj, kindly unmute yourself. Just.
No, thanks. So what I meant is that while they coming in, they also bringing the money to buy the shares. While they may get ESOP on the future milestone, but when I mean what I meant from the skin in the game is also they buying. So let's say if the angel round or the first round has happened at a valuation of, let's say, $5 million, and a 1% share is worth $50,000. When they're coming as joining as a CMO or a CTO, they also buy that equity maybe at 20 or 30% discount.
Yeah, these kind of things are typically, so whenever there is in early stage, you're doing angel rounds, you typically give discounts to your leadership team or early stage employees so that they can build more equity. But that's not skin in the game. Skin in the game is, okay, you want to join me as a CTO. Okay, I can only take you as a CTO provided you put in some money into the company. That's not the model which I've seen. Where we've seen model, okay, you come join us as a CTO, I'll give you 50% of the market salary, but I'll give you 2% of the equity of the company.
Correct.
Thank you.
Okay, thank you very much. Sheetal, Anishji, over to you.
Yes, over to Anurag.
Thank you.
Thank you so much, Vikas and Saina, for taking our members through the entire experience journey as a CFO, and it's really enlightening to see some of the good stories and some of the good experiences that Vikas has shared, because I also been part of GT some point in time when you probably have left. So I was also ex-colleague of Grant Thornton. So thank you very much for enlightening our member. I really say clap to you and Saina together.
Thank you.
Thank you very much. Now it's time for us to invite our next speaker. And to introduce our next speaker, I would like to ask our executive committee member, C.A. Rajiv Hira, to do the introduction, please.
Thanks, Anurag. So it was an amazing session so far. So what we have seen and how things are changing in the startup space, it's amazing. So I'd like to introduce C.A. Davesh Lechika. He is founder and CEO for Marwadi Catalyst Ventures. He talks himself as a chartered accountant by accidental choice. So we would like to know more from his side why he call himself accidental choice. So Davesh is a co-founder and he's typically working in tier 2 and tier 3 cities and building up, he's having a complete mission how the robust ecosystem of startup and career development can be done. So would like to know more on why tier 2, tier 3, because that's his core forte. And he's a firm believer of the fact that startups are rewinding India's economic roadmap, and Devesh strives to drive challenge of supporting the startup that are risk takers and wealth creators for the better future. So I think Devesh would like to know the noble cause which you have picked up by getting into the space where normally people don't like to touch it across. And we have seen, like as your credential says, you have worked in majorly in the non-metro cities in India. So it's a complete pleasure for the chapter to invite you and looking forward to get a good perspective from you. Devesh, you have to unmute yourself. You are currently on the mute. Welcome on board. You are still on mute.
Devesh, unmute yourself.
You are still on mute. Yes.
Yeah. Thank you, Rajiv, for this wonderful introduction. Like, I'm nobody, trust me. I'm just trying to play my part in this startup ecosystem and this world. Thank you, Anish sir. Thank you, Anurag sir, for inviting me. I have attended lots of sessions from India. I believe ICI Dubai is doing some wonderful job enlightening our fellow members across globe. And I feel honored to be one of the speakers today. And more honored because I have to talk about something which I love, something which I've been doing since over 2 years. So let me also share my deck. About me, I'm a chartered accountant, passed in 2006 November. Why I call myself a chartered accountant by an accidental choice? Because I was always inclined towards technology, but there was a force major from my grandfather who wanted himself to be a chartered accountant. He couldn't. He wanted my father to be a chartered accountant. He couldn't. So I realized if I don't become chartered accountant, I have to fulfill my family's dream of having a chartered accountant in the family. So with that intent, I was successful, cleared C in 2006, moved to Mumbai, worked with Morgan Stanley. Then in 2012, I had an opportunity of going to US and work with Morgan Stanley US for H1 Technologies. But there I realized that there are lots of opportunities and growth chances in tier 2 and tier 3 cities. And to live a more impactful life, I decided to come back to Jodhpur. So I'm a proud chartered accountant from a very beautiful city called Jodhpur. It's a small city in Rajasthan. So until 2018, I was working with different organizations. And until 2018, I failed 3 startups. So in 2015, I created one company, invested all my savings into it, burnt entire money, failed. In 2016, created another company, जो भी थोड़ा there was small saving invested into that, again failed. In 2017, I invested a small amount of money in a startup, failed. So after 3 failures until 2018, I realized that there is something which I need to do at my own. So I took my second leap of faith. I've taken lots of leap of faith in my life. The first one was getting married, then this was third. So I started a company in Jodhpur, Yearbook Canvas, in 2018. And quickly we started scaling up the business, and we realized that the businesses are possible from smaller cities. And today I'm very, very proud to say Yearbook Canvas is India's #1 yearbook publishing company. Number 2, it's Asia's only company to do yearbooks using yearbooks mobile apps. So like we have got mobile apps for both iOS and Android. And while working on this startup, while scaling up on this company and raising funds for this company, we realized that there is a huge gap, and there are lots of challenges for smaller cities. So why I'm telling you my story, probably I'll request everybody to correlate the things, what a startup founder or what an investor in smaller cities, what are the challenges which we have to face as an investor or as a startup founder or any ecosystem player, and how probably those challenges should be overcome and how we overcame those challenges. So while raising funds for Yearbook Canvas, we realized there are lots of challenges, and we decided to grab them as an opportunity. And we created a company called Marwari Catalyst in mid 2019. Marwari Catalyst is a startup accelerator. What we do, we help startups to grow their business. We have got different ecosystems within our company, like digital marketing, like PR, like financial acumen, legal services, compliances. So once a startup is onboarded with Marwari Catalyst, we ensure that the founder of the startup is supposed to focus only on growth of the startup. And probably in less than 1 year, Marwari Catalyst became Rajasthan's largest private ecosystem player. We are one of the fastest growing accelerators of India. As we'll go ahead, I'll share something which we have been living upon, me, my team, my partners. So what is a startup ecosystem? Like this is something which I've lived, which I've learned practically. So I'm just sharing. People with right mindset. It includes right entrepreneurs, lots of focus, right team, right mentors, right investors and customers. Then right market. Market is like lots of consumer base has now shifted to tier 2 and tier 3 cities of India. Right infrastructures, which includes incubators, accelerators, colleges, universities, lots of e-cells are there, and most importantly, technology and internet. After Jio has come, it has become a wonderful leveler for across India, and most importantly, not last but the least, access to the right capital. Angel investors in smaller cities of India or tier 2 or tier 3 cities of India, they've got deep pockets as compared to metro cities. Why? Because the income level is good and the cost of lifestyle and the cost of livelihood is relatively less. So this delta is a kind of disposable income, and there are lots of funds which have just set up in smaller cities of India. There are lots of ecosystem players which have just arrived in smaller cities of India. So this comprises of ecosystem. And why this is important? Because to bring more successes stories, right? So if you want to grow strawberries in Rajasthan, if we don't have right ecosystem, so if we create a right ecosystem in a closed door, we'll be able to grow strawberries. So that's the importance of startup ecosystem. So why the world is looking up to startups ecosystem in tier 2 or tier 3 cities, and why we are very, very bullish about startup ecosystem in smaller cities of India. First, as I said, internet, it has it is like a boon. Because of internet, people from across India, they have come back to their hometown. They are able to work from anywhere. It has also served as a good leveler. It is also helping the tech startups to grow further. Second thing is lots of IITs, IIMs, national institutes like NIFT, FDDIs, they have set up in smaller cities of India. So over 80% of these institutes are now in smaller cities of India. As I said in past, more savings, which leads to more angel investors. Resources at a very reasonable and good prices. So as compared to bigger cities, if you have to go and set up in offices in smaller cities, there are more chances that you'll get good resources and at a very reasonable prices. Of lately, we have started seeing good and very good successes in smaller cities. I'll be sharing some names in my upcoming slides. Now, very important aspect, there are some wonderful ecosystem players who have formed and focusing only in tier 2 and tier 3 cities. Marwari Catalyst is one of them. There are lots of many. And the last thing which I've been observing, reverse brain drain. So the biggest challenges for smaller cities was brain drain. Good brains from smaller cities, they used to move to bigger cities to global level, international. Now what has happened? Because of COVID, lots of good people, they have decided to come back to their hometowns. And what this will cause? They will push the ecosystem of smaller cities to be a next level. B, if they have come up with right mindset and right knowledge. And when these people, they start something at their own or they join some company, they'll ensure that they make bigger impact. There are many other reasons which we have been observing, and we are very, very bullish about startup ecosystem in tier 2 and tier cities. And so a few success stories. Car Deco, this company is based out of Jaipur. This company is valued at $650 million in 2019. It is supposed to become a unicorn in this year, in this calendar year in 2021. Fleeka, it recently raised $4 million from Bridgestone. Yearbook Canvas, as this was one of my one of my company. It is again a multi-million-dollar company. Hopefully, we'll be seeing some good news very soon. Then Tinkerly Labs, Presso Car, these companies have recently raised some good funds, and we are very, very hopeful about many good success stories. So this is a very important thing. As a chartered accountant, and I've been associated with lots of chartered accountant. I was very, very lucky. I'm still very lucky that like none of my problem was unresolved. Like being a chartered accountant, all I have to do is ask to the community of chartered accountants, hey guys, I've got this problem, and that problem is resolved. So as a chartered accountant, we should be partner to the success of startups. Catch them when they are young. To win the game, we have to be part of the game. So with the skin in the game, we should catch the right startup at the right stage, invest in them with very small amount of money as an Indian investor, work with them, help them in understanding the financials, because most of the startup founders from tier 2 cities, they lack financial acumen. And this is where we chartered accountants play a very, very, very important role. So something very important about Marwari Catalyst. So before I start something about Marwari Catalyst, right, I like to share a quick story. and I'm pretty sure that we all will be able to correlate with that story. Around 20 years ago, when we used to go for a family trip with our family, right? How it used to happen and how it is happening right now. The father or the parents, they used to book the tickets. They used to go to the counters of train booking centers, and I'm pretty sure most of the people who are from India will be able to correlate this story. My dad used to go to the counter, book in Tatkal 2 days before, early in the morning. Then on the day when we were supposed to leave, as a youngest child, I used to go and beg an auto wala or taxi wala or rickshaw wala to drop us to the railway station. We used to go to the railway station. My the mother used to cook lots of food so that we can carry with us. We used to reach our destination station, and over there we used to again back to the auto walas, taxi walas, rickshaw walas, whomsoever, and either we were lucky, we would have booked a ticket, a hotel well in advance because of some network, or we would hunt for a good hotel by searching for it in the hill station. What used to happen? The first hotel, because we were tired, we would go with the first hotel, howsoever it was. We used to roam around the city, and we used to adjust with the food which was served in the hotel or nearby restaurant. We used to come in the similar manner. We used to get a train ticket or flight ticket, and same thing used to happen after reaching to our home destination. We used to back to the auto walas or rickshaw walas. And what happens now? Today, and I'm talking about a very small city called Jodhpur and any other city in India, right? If you have to book a ticket, we use startup. If you have to go to any place, we use Ola or Uber. Again, a startup. We reach our airport or railway station. Before we reach to our destination station, we have got some wonderful startups: Airbnb, Oyo, Booking.com. We book our hotels through these startups. If we reach to the hotel and the hotel is not up to the mark of as per expectations, what we do? We have the right to upgrade our hotel or change our hotel without any trouble. After traveling into the city, when we are tired, we have the opportunity of ordering the good food using few wonderful startups, Swiggy or Zomato. Then vice versa. So startups have made our lives very easy, very comfortable, and startups have solved lots of problem of common India, and that's going to be the bigger role of startups in tier 2 and tier 3 cities now. Now coming to Marwari Catalyst, we started in 2019. We are an accelerator. There are different stages of startups: ideation stage, incubation, acceleration, then funding. In funding, there are Series A, Angel, Series A, Series B, Series D. So we are accelerator where we focus on startups at the growth stage. This is very important aspect of Marwari Catalyst. Out of 24 partners who are part of Marwari Catalyst cap table, 16 are chartered accountants. And answering their questions, they made me so much wiser, because when we all will agree, we all are very technically sound when it comes to finance. So when I'm surrounded by so many chartered accountants and answering their questions, this ensures that my wisdom, the wisdom of our entire organization, it grows, and we are able to deliver what we are, and whatever we are today, right? We are because of our these wonderful partners who are based out of US, Silicon Valley, UK, Oman, Abu Dhabi, UAE, Hong Kong. Some important aspect. Marwari Catalyst is Rajasthan's largest startup ecosystem player, and we are one of the fastest growing accelerator. Very recently, we launched our first cohort focusing on edtech startups, and you'll be surprised to know that we received over 150 applications from across globe and from across country. We have filtered some of the best startups, and we'll be working with these startups, and we'll help them in solving the day-to-day problem of Indian education system, whether it's smaller cities or larger cities, that doesn't matter. And this is something which I've been talking to myself, like anything which I've ever done that ultimately was worthwhile initially scared me to the death. By this, what I meant, we have to take leap of faith. I was working in different organizations, for different organizations, achieving their goals. Uh, Always wanted to do something at my own. Failed 3 business, but never gave up. Invested in the company. Whatever money I had at that time in 2017, I invested in a startup. That company failed. Never gave up. With my partner, formed first company, which is a $5 million company right now. We formed second company, Marwadi Catalyst. It has become Rajasthan's largest startup ecosystem player A, and we are focusing on something which we all love. So this was something quick about startups in smaller cities of India, tier 2 and tier 3 cities of India.
Thank you, Devesh. Anurag, if you allow me, I'll ask one very quick question to Devesh.
Please go ahead. Please go ahead. I have also a few questions. One question to Devesh that I'll ask later.
But Devesh, it was really wonderful and a matter of proud, because many of us are coming from very smaller cities across India, and we would be watching for the first unicorn coming from the startup. So we'll be crossing our fingers and keep watching for that. I would want to ask you, it's quite daring on your part as well, right? That you've taken it from a smaller town and taking it forward. What kind of challenges you are facing? Because entrepreneurs in the smaller towns, no question about their intellect, their brains, and all that, but they always struggle on the reach and access part of it, right? When it comes to the pool of capital, you mentioned there's a pool of capital that is available, within these cities as well, and probably more disposable capital at hand. So how are you connecting those two dots? And what is the key? If you have to just say it in one, because investors also are not very savvy in tier 2, tier 3 cities. So how are you convincing investors to invest in such startups?
Thank you, Susan. This is a wonderful question. And I'll be able to answer this because I've faced this problem, right? As a startup founder, when I raised funds from Yearbook Canvas is a funded startup which had done first round of funding and hopefully will be closing the second round very soon. I've always believed, like, if we look across globe, there will be some good brains who are leading good organizations, and they all belong to smaller cities, right? Second, there are some wonderful people who are in smaller cities who are doing wonders from smaller cities. So everything which was required was to connect the dots. What we did, we connected right people with the right mindset, with the right team, and we convinced them. Initially, it was very difficult. To be honest, it was very, very difficult to get the first check. After getting the first check, Seetal sir, it was very easy for me because that gave me a very good confidence. So I've got an angel investor from Hong Kong. I've got few angel investors from entire Middle East. I've got few angel investors from US Silicon Valley. And looking at these angel investors, right? The angel investors of smaller cities, they have been activated. A. B. What has happened now? Very recently, in India, Mr. Modi is followed by lots of people, and he's talking about startups. The best of the colleges, they have got e-cells. They are talking about startups. Best of the entrepreneurs or best of the lalas or CMDs or the owners of companies who are based out of smaller cities, they have been defeated by startups who have just started. Right. A recent example is Byju's acquiring Aakash. So Aakash is a very, very old company, and Byju's, which just started very recently, and it acquired. It is a proven fact. What has happened? So I've been traveling a lot, Seetal sir. Probably in last 60 days, I would have been out for almost 45 days. How I travel is like I took my car, I drive by road, hunt for the locations and to meet good people, to create good connects. And I was so excited. I had a chance to meet Bombay Stock Exchange head MSME IPO. I had a chance to meet some wonderful person who is heading a very good consultancy from Big Four of India. And they all are excited about startups. What has happened is every other person is now aware about startups. A. B. Some people they are just looking from outside as an audience, and there are very, very few people who have decided to be part of this game. And I always say this thing, that to win the game, you have to be part of the game. Otherwise, as an audience, all you can do is just clap, right? So anyone who wants to be part of startups, come with the skin in the game. Only then this thing will become priority for them. Okay? Another very important aspect. Now there are lots of success stories which are coming out of smaller cities. So this is motivating people to get associated with the right partner. All someone has to do is like catch them when they are young. So like get associated with some startup as a learning, put some money. So I am just sharing my personal experience, right? When I invested in that company in 2017, I put my entire savings. It was a very small amount. I cannot even say that on screen. That company failed, but that amount served as an MBA for me. And in 2018, that kicked me. That gave me a kick where I could leave a very comfortable job. And I was head of finance in Ananati Group. I used to go to office at 9 a.m., used to leave at 6 p.m., used to come to home, do my cycling, play with my kids. I left that comfortable job. I used to earn good money in smaller city called Jodhpur as well. Left that job at the age of 35, started first company, started second company, Marwari Catalyst. And by the grace of God, and I would say we have been doing good. People know us across globe right now. There were instances where people talked a lot about us, and very, very excited.
But one question that I have, Devesh, I mean, you answered very rightly question. But I mean, people talk about startup and everybody talk about unique idea. Ultimately, every single thing centered around the way of doing things, I believe, right? It's all about the idea is not unique. Everything is not unique. It's probably the way of doing the things. What is your view on the, our members, like, our, thousands and lakhs of our members are into practice. Why they are not getting the funding?
So
why they are not getting into the traction of like, startup? They like a chartered accountancy firm, which offers audits, which offers like compliance, which offers a different sort of services. I mean, we ourselves convocate for a lot of people, you come and invest into the business. We promote a lot of businesses outside. But my key question that, why we're not talking about the chartered accountancy world itself, because that centers around a lot of services. I mean, the gamut of services that people do. So what's your view on that and how you are looking into this entire sector? I mean, if you have looked into any of the firm in that particular service, that will be helpful for a lot of our members. Yeah.
Right. So Anurag, there are two questions in this. First is ideas being very unique, right? I'll first like to talk about that because this is something which we have been living. As per me, like ideas have got no value, right? No idea can be unique. Like Uber and Ola. We used to have cab even past, we have now, right? There will be something different in the coming years. What matters is the execution. So you have to, as a founder, as a startup founder, you have to take a decision and then make it right. By this, what I mean is, if you implement and you start working on an idea, which is going to be there for next 10 years, right? You have to ensure that you give your 100% on, maybe even 200%. Like we work 17 hours a day, even today, right? And you have to make it right. This first thing.
So Devesh, my question is with
I'm coming to your second question about CA as a community, right? So I would slightly disagree with this question, Anurag, because out of 24 persons who are in cap table of Marwari Catalyst, 16 are chartered accountants. So 2/3, right?
No. My question, Devesh, to you is that, you are investing today in tech-driven company. You are investing in today a new edutech coming in, fintech coming in, healthcare coming in. I'm saying like, the funding in the chartered accountancy world itself in a practice. So let's say in India, there are lakhs of people who have started their firm. People with the creative ideas, creative knowledge with respect to either in audit or in tax and things like that. Why people do not invest into the chartered accountancy firm? I mean, probably you might be aware, but I until now don't know, like, somebody has go and put together as an angel investor in somebody's firm in India as in chartered accountancy practice, people in profession. So is there a specific reason for it, or people are not approaching out to people, or there's a specific reason in your opinion?
So Anurag, that can be because of strict regulations by the Chartered Accountants Regulation Act.
Right. So
the partner has to be a chartered accountant only, right?
No, I mean, with the capital can be anybody's, no? There's no restriction on the
No,
capital.
I don't think so. You cannot make partner anyone unless he's a chartered accountant in India.
So this
if
is
it's in
what-
audit practice.
Yeah, I mean, point is that, look, not everybody is doing assurance, but a lot of people are doing different sort of things. I mean, I just want to understand from Devesh's perspective that,
Yeah.
I mean, until now, we
I'll
have-
try to answer. It will be very subjective answer because I've personally lived this life. So what happens when a CA is starting a practice? Like, we are forced to do practice in a very traditional manner. And I'll apologize for using these words. We cannot do the business the way the new age and entrepreneurs are doing, right? We cannot market ourselves. We cannot sell our stories, right? We have got so many restrictions on a CA firm, right? That none of the investors will be seduced to invest in it. First. Second, I believe lack of technology, lack of uses of technology. I believe AI and ML, they are going to replace lots of manual work. Like 30 years ago, when my father was in Bank of Baroda, right? The way he used to work and the way banking is driven today, it's going this factor. If someone comes to me that I'm going to build AI and ML and start practice on this, there are chances I will personally invest into it. The same thing used to happen with lawyers. Now there are some wonderful law firms who have started using technology, working and solving the bigger problems, right? So there are ample of opportunities for any chartered accountant to form a company or to form a firm and use technology, scale up the business and raise funds. If Jio could have, so like a classic example is Jio raising funds, right? It gave everything for free. It captured the market and it raised huge funds. So if Jio could raise funds, anyone can raise funds. So we have companies which is into vegan dog food. We have companies which are into edtech sectors. We have got companies who are into kind of social entrepreneurship. So any business can raise funds. First, it's the mindset of the entrepreneurs. Second, storytelling. Third, the right way to market their product. I hope I've answered your question.
Anish, what question do you have for Devesh?
No, I think our members have the questions, so we'll take one by one. Since Sheetal is on phone, I'll ask Bhavna to go ahead.
Hi, Devesh. This is Bhavna. Actually, we have a special connect. Actually, we are on common ground. Not only are we in the same profession, but the startup I'm advising is from Jaipur.
Wow.
So yeah, so that was something, and they are also chartered accountants. We have this core team. One important thing which I wanted to ask you is, yes, we have an advantage, but since it's online, we have that accelerated, opportunity that we can reach anywhere, and just not that because we are in the tier 2 city that it really matters. But with all this, our main challenge is forming the core team. Since we are primarily chartered accountants, and as you said that we require the marketing, we require the other people also. So how do we go about that? That is the biggest challenge.
Bhavna, this is something which I used to face. Like when I started Yearbook Canvas, right? There was lack of technology, there was lack of PR, there was lack of digital marketing, right? I'm talking about 2018, right? So over the period, I've realized that there are some things which we'll have to scatter across the globe. Not necessary. The world is now virtual, right? Everybody is working from home. First. Second, as a startup founder, what I did, I got connected with the right people who mentored me, who advised me on the right things. And that led Yearbook Canvas to become India's largest yearbook publishing company, right? So, Bhavna, are you based out of Jaipur? Because I'm in Jaipur for next 2-3 days.
Right. Basically, now I'm in Mumbai. Actually,
but we can connect offline, and I'll be very glad to help you. Trust me.
Okay,
because we are focusing on edtech right now.
Yeah. Great. That will be too great. I mean, wonderful. Yeah. Thank you so much, and thank you, Anish. Yeah.
Welcome, Mr. Vivek. Please go ahead.
Thanks, Devesh. Thanks, Anish, for this opportunity. I think I've been listening very patiently. It's been quite enlightening again. Devesh, you've been very passionate about what you're doing. I think it's great and wish you all the best in the future as well. as a chartered accountant and also post-COVID situation, have you seen, I think I've been talking about a lot on social impact investing, and so have you seen a significant shift through your personal experience as well, that investments are going towards companies or startups which are creating a larger social impact? Number one. Number two is, especially since you are investing in early stages, which is like just somebody had just had an idea, had a little bit of product in place, and then you like to accelerate the progress of the company. So as a professional, finance professional especially, where corporate governance or financial controls are very, very important. So how do you see that, how these investments which you're making and how they are being managed properly, so what role do you see? Do you put certain additional controls in the company which you're investing? And how does corporate governance play a role in your decision to invest or not to invest?
Right. So regarding your first question, post-COVID or even during COVID, like COVID has taught a man to be more wiser, right, and to be more grounded. Right. So this is again a very subjective answer. Personally, I'm not interacted with some wonderful companies like this which you have asked, right? But there are chances that people will be more interested. Why? Because people have moved back to their hometowns. Right. So I've got few friends who used to work in China, who used to work in Singapore, who used to work where not, and they are working from Jodhpur, earning in dollars, spending in INR. So they use money, and they have seen some bigger problems on the ground in their cities. So if there are some cities, there are startups like this, people will be more interested. And again, Vivek, it's a very subjective thing. So like someone may like orange, someone may like apples, right? So it depends upon the investor psychology and the startup founder psychology. And when they connect, there'll be movement of funds. There'll be movement of growth. This is very subjective. Second thing, it's again like I've seen good shift, and this is my personal experience, right? I've seen shift in smaller cities. And when we invest in companies, we have to ensure that first, like, the investor's money is safe, because when we invest or when we invest our time, whether it's money or when we invest, lots of things are on stake, and our success will be defined by the successes which we give to the world, right? So we ensure that the founders are ethical, the money which is being used by the founders is safe, and whatever they are doing is going to ensure to serve the purpose what they are doing.
So Devesh, probably I'll stop you here. There are few questions on the chat, and I just want very brief answers on them, and then we can go for the formal vote of thanks. What is the minimum investment that one could look for startup companies in tier 2 or 3 cities?
So
very short answer.
Right. It could be anything between 2 lakhs to 15 lakh rupees.
Okay. Name any 1 or 2 startups from the tier 2 or tier 3 cities.
There will be some wonderful startups. One is obviously mine, Yearbook Canvas. You can bank upon my words, and it's going to grow.
Other than that,
Fleeka is a wonderful startup. It very recently raised $4 million from Bridgestone. It's a tire management service. FLEECA.
No, what it does?
It is into tire management services. So the biggest challenge for the transportation company is the management of the tires. It is the second largest cost, right? So whatever they do, they ensure that this cost is reduced.
Okay, fine. Thank you very much with this. And I think I can repeat what Mr. Haridas Achar has said, that this event could not have come on a better day than today. 5 years on this day, PM Modi launched the Startup India initiative.
Wow.
Wow.
So today, rupees 1,000 crore Startup India seed. With this, over to you, Anurag, for formal vote of thanks and giving certificate of appreciation.
Thank you so much, Chairman Sir, for asking the last rapid fire question. So now I would like to ask Sheetal to share the certificates for all the speakers today, eminent speakers. And in the meantime, I would like to thank our sponsors, our principal sponsors, Danube Group, Tally, Shura, which is into establishment, Lulu Group, our platinum sponsors, Century Financials, Creston Menon, MMGS Group. Please reach out to them for assurance and tax audit services. IFCO Group, AGMC, buy the BMW cars. It run perfectly fine, and it's value for money. CRIF, Dun & Bradstreet for valuation and credit rating services and risk and assurance. Clyde & Co. are law partners, so law firm. Please reach out to them for any law-related things. Our media partner, Khaleej Times, our institutional partner, Delhi Private School, and our banking partner, Bank of Baroda. I would like to thank each one of them for continuing their support to ICAI Dubai chapter to bring out to all of us such events of great magnitude and value to all the sponsors. Sheetal, if you're ready, we can share all this.
Yeah.
Just trying to get them. Anish, you have them handy with you? Because I'm just trying to search them on this.
I'll just see. Yeah.
All right. And in the meantime, one thing very important today's session that we have learned, that an idea is something which is very unique, and one shall have the belief and the confidence and perseverance to pursue that entire idea. There are people who are watching for you. There are people who need your expertise, but one thing that remains common in all the startup is that the journey begins with you. The journey begins with you. If you have the confidence in yourself, then only somebody else will have the confidence. Somebody else cannot have the confidence until you have. So please have the confidence in yourself. Start, and everything will be all right with you. You know, I mean, that's what I can say to all of you from the learning from today's session.
Some goof up.
Yeah. I think
last statement, all
able to put it.
investments are subject to market risk. Please take your own.
तो समझ के पैसा डालेंगे सर.
No, we need to say that last statement. So that's important.
All subject, yeah. That's true.
It's in the WhatsApp group if someone can access.
Yeah, it's being accessed. Hari is sharing this.
I have given you, Sheetal. It's in your WhatsApp.
Thank you, Mr. Sanjay Jha. Mrs. Shanti Mohan and CA Nimish Kampani and CA Devesh Rakesha. Thank you very much for sharing your insight.
It was pleasure.
Thank you.
Okay, let me share then. Who can you remove it? Let me share it. Okay, thank you, CA Nimish Kampani. Thank you from all of us. Thank you, Mr. Sanjay Jha. Thank you, CA Vikas Vadavan. And Saina, we don't have certificate, we'll prepare. So thank you very much, Saina. The fire chat particularly was very good. It was so interesting. Lots of feedbacks are coming positive. And last but not the least, CA Devesh Rakesha. Thank you for your time. Thank you all the eminent speakers. It was pleasure having you, and lot of information you have shared. Lot of knowledge has been learned. Thank you very much.
Now I would like to ask everybody to unmute themselves and they can say thank you to everyone, and your feedback is always so important to us to improve upon. And round of applause for all our speakers today.
Thank you all. Thank you all.
Thank you. Thank you, everybody. Thank you, Sheetal, Anish, Anurag. Well done.
Thank you.
Thank you.
Thank you, Devesh, Nimesh, Saina,
and what
Vikas.
next? To hear you all. What next? The budget is definitely on the card, so we are coming up with a very powerful and power-packed session on